All right, there we go. Everything is looking good. Should be able to go ahead and get the stream started now. Having some minor difficulties with YouTube. Hopefully it is displaying this stream for you guys out there. I was having trouble getting it to link up myself, so somebody let me know we're coming through loud and clear. I would greatly appreciate it. In the meantime, we'll go ahead and get started. Welcome back to the channel, Crypto Trend Trader, with our Friday morning market wrap-up. It is 11 a.m. Eastern Standard Time on September 9th, 2022. And as always, before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Okay, so let's go ahead and get rolling here. Obviously, we saw a little push up in Bitcoin last night, about a about 9 or almost 10% move. So nice little move. We had discussed the move and what might be the catalyst for it in the previous stream. We'll go ahead and talk about that. Talk about our next targets and what we expect to follow, and also what were the early signs that we were likely to get this rally we've seen not only in Bitcoin but also in equity markets as well. So let's go ahead and jump right in. So I think the most important thing that we'll notice right off the bat is, obviously, we know in order for any kind of rally to happen, especially to sustain in any of the speculative markets, we know that we need to see some weakness in the DXY as well as TNX. And we know TNX has shown a little bit of strength since then, but we basically had a decent little down day. Not crazy or anything. We're still at the highs. But that little bit of reprieve was able to let the equity markets rally. Same with the DXY. We put in a bearish engulfing candle here, a little indecision candle, and then we got the move we've been discussing. We come down and tap that 21 moving average. So we'll actually start with the DXY because I think it's got the most important things to pay attention to. So I appreciate that, Sohail. Good to see you, brother. So for the DXY, we discussed this exact move, just basically the back test of the previous high right here, as well as our 21 moving average. Still in a very powerful uptrend, but obviously we saw some initial signs, a hard sell signal. We left the bullish control zone. It's also worth noting that we could see a more intense, potential sell off here, as we do have our peak right here and our peak right here. Essentially at the same level. This one is slightly lower. And then if we look back at the previous, group of peaks back here, that one is a little higher. So we have basically been building from this peak through here, our first drive, here's our second drive, and then this is our third drive now of bearish divergence. So we have a high, we have a lower high, and then we have a lower high than that. We have a high, we have a higher high, then we have a higher high than that, and then again a high, a lower high than that. So we have daily 3 drives of bearish divergence confirmed at this point in time. Now, obviously, at any point in time, we can just come up here. The indicator oscillator can reset, move back to the top of the range, and we can just continue. As long as that continues to move to the upside, we can invalidate the bearish divergence. Doesn't mean that we're necessarily just going to melt down and it's over for the dollar. Keep in mind, people have been calling the top on the DXY the entire way up. I think normally we stick a little bit more to our technicals and then we talk about some fundamental factors. I think right now there's some fundamentals that are worth note, obviously. So in the last couple of days, we basically saw a bunch of countries around the world, many of which are, many European countries, some of which are in the basket of currencies in the DXY, come out and do, sudden, very large, for them at least, rate hikes. So obviously the U.S. has been, doing 75 basis point hikes the last 2 meetings. Before that, we had a 50, etc. That puts us pretty high on the rates as far as, Western countries go. As the relationship between the dollar, relationship between the dollar and these currencies change, obviously, as they raise their rates, their currencies become more desirable. So if the dollar, let's say, for instance, is at the highest rates and everybody else is at low rates, and then everybody else equals the rates of the dollar or exceeds the rates of the dollar with their rate hikes, that makes their currencies more desirable. Therefore, a little bit of the shift comes away from the dollar, and we see the relationship start to kind of smooth out a little bit. Maybe see the DXY weaken in relation to the basket of currencies. Now, if one of those currencies in the basket doesn't hike rates at all and one hike rates a ton, maybe they kind of balance out and find themselves right around the middle. Obviously, there's different weightings. Obviously, there's different historical interest rates for these countries, etc. But seeing a couple of these countries come out with aggressive rate hikes, sure, it still only puts them at, in some cases, 1% compared to, right now, obviously, the United States is well above 2, on its way to 3. So, it's not going to just immediately undo all the damage that was done. It's not going to just immediately make people confident, that all of a sudden Europe is a good place to invest your money. But I mean, it at least helps a little bit. So that's obviously a fundamental reason why we're seeing some weakness in the dollar or the DXY. Now, that being said, we know that there is a rate hike scheduled for, just a few days away. Essentially at this point in time, a week and some change. Not even 2 weeks away. So if we know that, there's a very high probability the Fed is going to raise rates 75 basis points, and the big catalyst for, the dollar sell-off or the DXY weakness is essentially other countries hiking rates, 50, 75 basis points, etc. Well, we know that likely if the U.S. gets another 75 basis point hike, it's going to just take the dollar right back to where it was, strength-wise, in relation to those other currencies. Now, does that have to reflect on the chart? Does this have to be back at cycle highs just because that happens? No, it doesn't have to. But, the probability is extremely high because all of the catalysts, all of the drivers that have made the dollar so much stronger to begin with will basically just be back in effect. So, essentially just picture two cars driving in a race and, they're head to head, and then the dollar starts to pull away because of, it's raising interest rates more aggressively than the other countries. And then all the other countries, are behind now, various different degrees behind us, different distances behind the dollar DXY. And then all of a sudden, they hit their nitrous, they boost their rates 75 basis points. They're going to close the distance some. So perspective-wise, it might look like they're gaining on the dollar, or it might look like they're getting ready to pass the dollar, or it might look like the dollar is slowing down because suddenly all the other cars are catching up to it. But in all actuality, it's not like they're necessarily getting ready to pass it. It's not like all of a sudden the dollar is going to lose the race or anything. It's just not in first place by as far. So now all of a sudden, all the cars have hit their nitrous. They just did their 75 basis point hike or 50 basis point or 100 basis point, and they have used their nitrous to close that gap. And now we know the dollar is getting ready to hit its nitrous as well. If the other countries did not hike rates or hiked rates, 50 basis points or 25 or 0, or cut rates even, we would expect the dollar to skyrocket ahead because it's the equivalence of the DXY strengthening or the dollar raising rates without the other countries doing it. So in all reality, essentially when the dollar or the United States or the Fed raises rates, if everybody else doesn't raise by that same amount, the dollar will continue to strengthen relative to them. So that it's really the same thing. Whether the dollar, raises rates, the Fed raises rates another 75 basis points, or other countries, take away 75 basis points, it's essentially the same thing because the distance between the two doesn't change. So now we don't expect these other countries to be cutting necessarily anytime soon. I mean, people in charge are pretty dumb, so it wouldn't surprise me. But we don't expect that. So we don't expect, obviously, all of a sudden the dollar to just surge any more than it's been surging lately. The same way that if we continue to raise 75 basis points this meeting, and recently we just saw a lot of the currencies in that basket raise 75 basis points. In the meantime, for that 2 or 3 week period, we would expect some weakness in the dollar. And then essentially, once the 75 basis point hike is back in effect, we would effectively be right back where we were. Everybody's 75 basis points higher, but we still have the same lead. And that's the most important thing to pay attention to. So I think that the weakness in the dollar, at least short term, is very limited because we know already, obviously, the market is forward looking. So if when those 75 basis point hikes came in, or 50 basis points or 100 basis points, but essentially when a lot of the European countries, Canada, a lot of the currencies in the basket hiked rates, that closes the gap some. So it looks like the dollar is coming down. or is weak compared to those currencies, or weakening. But then again, we know the opposite effect happens as soon as we raise rates again. And we know that that's, a couple weeks apart. So in my opinion, this move is short-lived. Now, is it possible we sell off more in the next few days till then? And then when we get the bounce, it takes us up to a lower high. And then actually the dollar rolls over because, maybe the land war is over. The energy crisis isn't as bad as we thought. There is no food crisis. It was all made up. Whatever the reason is, maybe a giant hurricane hits the United States and, the power grid goes down. I don't know what the catalyst is going to be, but there's definitely a possibility always for anything to happen. So it's worth paying attention to, taking note of. Obviously, the dollar on the daily is still very, very strong. If we look at it here on the weekly now, we see this initial peak up here, then we see a higher peak, then we see a lower peak. So we're not looking at the bearish divergence the same way on the daily as the weekly. The daily obviously has 3 drives of bearish divergence on both indicators. The weekly does not. If we look right here also, though, we have the high, then we have a lower high back testing the stochastic here, and then we have what could amount to, it hasn't yet obviously, but could roll over into a third lower high. And we see that on the knife as well. We have the initial peak on the knife here, a second one here, and then a third slightly lower one here. And again, these correspond with those 3 peaks here. So we have some potential on the weekly as well for bearish divergence. We have a beginning of a rejection candle. We have a decent red body so far. Obviously, we still have till the end of the day to see how this closes. If it bearishly engulfs, it doesn't look great. Do we get something similar to this, where we see about a month of weakness in the dollar and a rally in equity markets, or a couple weeks and a rally in equity markets? It's definitely a possibility. We have discussed for quite some time that when the 200 exponential crosses above the 200 simple, once we confirm into a bull market like this, it's not uncommon to see at some point in time some kind of retest. Now, the stronger the asset or asset class is, the sooner the retest gets bought up. So on a, weak asset, we might come all the way back down and even penetrate the 200s before eventually going higher. On a moderately strong asset, we might come down and just barely front run them around 98, 99, even 100, and then continue higher. On a very strong asset, we confirm into a bull market, we might see a very, very shallow retest, and there's just too many people interested in buying it. In this case, too many people interested in getting dollars at a discount, assuming that it's not going to continue. Now, I don't know how strong or weak the dollar appears to people around the world, but obviously relative to its own price action, it's very strong. It's doing something it hasn't done in 20-something years. So the fact that we're confirming into, a strong bull market and doing something we haven't done in 25 years, on the monthly chart, taking out levels, obviously going back to, 2002, essentially, it's pretty damn strong to me. Now, we're at some key resistances. It's obviously we're seeing some resistance here on price action. Obviously, we're seeing some potential, that we could pull back some. Nothing to be scared about. I don't think that it's going to overall threaten the trend or anything like that. Again, if we just go out to the monthly and we look at our monthly chart here, very powerful uptrend, still fully intact in the bullish control zone. All green histograms, blue slope above the 0 line. We do see, what the beginning of what could potentially be a rejection candle, a large wick on top and, small body. If it flips red, and the bigger it gets, obviously, the worse it would get. Now, we still have like 3 weeks left on this, so we don't know what this is going to look like. It could be at new highs here, by the end of the week or the end of the month, or, it could be substantially lower. But obviously, as long as we're still above the 8 and 21, as long as we're still above the 200 exponential and simple, there's nothing really to be worried about here. Now, here's a similar situation where we see when we cross above the 200 exponential and then 200 simple, we get an initial back test, a higher high, and then we come down and back test both of them all the way. Obviously, this is, as the dollar was confirming, into a bull market. Once we penetrate the 200s in 2014, we started running up right here. And, from when it peaked, that was in January of 2017, to where it bottomed right here, that was in February of 2018. So we're talking about, essentially 13 months of downtrend before we come up here and basically put in a lower high, followed by another, roughly 13 months of downtrend, followed by, a new higher high right here. So, it's not crazy to think that we could actually, at some point in time, whatever the catalyst is, where the dollar reverses, that we could see a temporary reversal in the dollar that could last for, a year and take some serious pressure off of, foreign currencies, foreign equities, even, domestic equities as well. I mean, the stock market could rip if the dollar shows weakness, if yields show weakness. Now, we don't expect necessarily yields to be showing weakness anytime soon. We know the dollar and TNX, or, whatever yields you want to use, have been trading in lockstep now for quite some time. That doesn't have to continue, obviously, but it has been for some time. So we would assume that it would continue going into the future. So we have to be looking at a potential scenario where we do see, a dollar backtest of some key levels. But also, we should continue to just assume that the trend in place will continue in place. Now, after 2 backtests right here, is it likely we get a backtest all the way down to that area? I think it's much less likely. I think the likely long-term target for a backtest is probably like 100 to 102, which again, is a big move in currency markets. So if we did get something like that over the next 6 to 12 months, that would be a big deal. So it's worth paying attention to. But obviously, everyone that's been calling a top on the dollar on the way up, they called the top right here and then got a massive green candle in their face. Then they called the top right here and got, 4 more big green candles in their face. So again, I'm not going to be the one who sits here and calls the dollar. I mean, there's definitely some reasons to consider that this could be the top. I mean, we talk about this key area. This is obviously our 786 and our 0.5 macro. So the 786 is from the top right here to the macro low. And then the 0.5 is from the all-time high to the macro low. And now we're looking at the dollar chart on the monthly. So it's going back to like the 1960s. Don't worry, but there's obviously a lot going on here. But this is the level, this is a key level we talked about. If we break through this descending resistance, if we break through the 786 and 0.5, which line up perfectly, it's rocket ships, because we're basically coming up here to retest the previous high at 120. Now, we did break through that. We did close above it. We opened above it again. And we'll have to see what happens in the next 21 days if we close above it again. If we close above it again, consolidate long enough, we likely see continuation, as we'll have confirmed a breakout, back-tested support, and then we would expect continuation. Obviously, we have the 886 at about 114. Then we have the 618 in red at 119. And then we have the previous high at 121 from back in 2001. So those are the next areas to watch. And then after that, it's basically just a backtest of the all-time high. There's a little bit of resistance along the way, but that's the key areas to watch. So there is quite a bit of resistance right here. We did break through the majority of it, and we're consolidating above it. But it is worth paying attention that if we see continued weakness in the dollar, it makes sense for us to be bullish on equities. All right, so that is enough about the dollar. So we talked about the potential bearish divergence. This daily close or weekly close will be important, obviously. The key levels to hold on to are obviously those fib levels. Staying above 107 is pretty darn important. After that, we'll pay attention to what's happening here. And obviously, we take a look at the dollar every day. So we need no secret as to what I'm seeing develop in real time. So now let's switch over to TNX and talk a little bit about that. So many of the same factors over here. We're seeing the sell by sell signal. That is a bearish divergence signal from the knife, or from the jewel rather. It's not perfect. The sell and the buy are touching each other, and then there's a space between the other sell. Still pretty reliable. Still pretty reliable. If it's just one space separating this from like, symmetry, still pretty good. Now we are slightly below the previous peak right here, so we're not seeing any actual divergence developed yet, as we have a high right here and a slightly lower high. So the fact that we didn't put in a new high right here with less energy doesn't give us that same bearish divergence like we see on the dollar. We also saw, as we're seeing continued weakness in the dollar over the last couple of days, we're seeing a little bit of strength showing up on TNX right now. It is at 3.29 right now. The cycle high is really only slightly higher at 3.48. And while we don't necessarily expect this to jump 75 basis points when the Fed hikes 75 basis points, obviously that is a serious tailwind for this. So even if the Fed came out and hiked 50, we would expect this to move up accordingly. If they come out and hike 75, obviously we would expect a pretty big surge in it. And again, strength in the dollar, contrary to what we're seeing, in the actual dollar chart. which is sometimes, fundamentals and technicals not going to line up, and that's okay. You just have to figure out which one is wrong. You fucker. So basically, we don't know which one is going to come up here, and if this is going to put in a new high, if this is going to start showing weakness more in line with what the dollar is doing as well. We'll have to obviously wait and see how that develops. But, we have a laid out plan of attack here. If this falls back down, we know key areas to watch out for. We have obviously some key supports. We're not that far above the 200 exponential on simple. I don't think it's realistic that we're going to come back down to those levels. Unless suddenly the Fed cut rates instead of hiking 75 basis points or something like that, which again, I give a near zero probability. Now, we do still have some important data coming out. If we look over at the weekly chart here, we basically left the bullish control zone quite a while ago, and we had essentially a bullish reset take place. The stochastics came all the way back down to the bottom of the range, or at least, closer to neutral. And now the blue stochastic is angled back to the upside. We're actually close to, potentially getting continuation and breaking back above the pink. The jewel knife rather is already, powerfully angled to the upside. We see here on our histograms, we break down below the slope line. We're back above it now. Did stay blue the whole time. If we stay above it now and start to just creep up here, we basically have reclaimed this level. If we get rejected and start to move back down here below the blue slope line, that is a very, very strong rejection worth paying attention to. Now, we did see between this peak and this peak some bearish divergence take place, and that led to our sell-off over, the following week and some change. At which point in time we found support around the 21, and then we stopped the cross. Just like with the dollar, the most important thing to pay attention to is, does the 821 daily cross bearish happen? And then at that point in time, we can start looking for downside targets. Same thing here. We just saved the cross here. We're threatening the highs on the weekly. On the daily, we're still a little ways off the highs. On the weekly, if we just close today, right now, we're closing at the highest highs of the cycle. If we go any higher than 3.29, we're potentially closing a higher high for the cycle, a new high. So we're seeing strength in TNX, still very, very strong. So what does that say for all the people that are bullish on bonds and keep talking about how the massive bond rally and bonds are at a great deal right now? Well, obviously somebody's really, really wrong. Either the people that are trying to get bullish on bonds right now are really, really wrong because they have recency bias and, they only have daily and below time on their charts. They can't look at weekly or monthly charts. Or maybe I'm wrong. Maybe I'm completely wrong and bonds are just an amazing value buy right now. And actually, all of the technical stuff from the charts, all of the fundamental stuff, like the Fed about to raise 75 basis points, and obviously the TNX is not going to be under the Fed funds rate. That would basically be a 10-year yield inverted with a overnight yield, which is, absolutely unheard of. Now, some people watch the 3-month and the 10-year. I like to watch the 210. It's worth watching, the entire spread. But realistically, doesn't make a lot of sense for a yield curve to be inverted for long periods of time. But when you look at the rationale, it actually does. But for an overnight rate or something like that, that's getting pretty extreme, something that we don't see often or, ever, depending on how insane it gets. If you think about the extremes and just say, okay, what are the two extremes of the spectrum, for yields? Well, you have basically the Fed funds rate or the overnight rate that banks can, loan their money to the Fed and get overnight. And then, they could essentially do that for an entire year period versus, obviously it's an overnight rate. So if you got, let's say 3% overnight, you don't get the full 3%. You get 1/365th of 3%, obviously. I know sounds basic, but, it's worth just reiterating. As opposed to, let's say, a 30-year where, you lock up your money for 30 years and you lock in that rate of, let's say, 3% for the next 30 years. And if you have to sell, there's a penalty, so obviously you don't want that to happen. So the important thing that takes place is, obviously, if you're uncertain about the next 30 years or you're uncertain about the next 2 years, that might influence your decision of whether you're comfortable tying up your money, just overnight or for 2 years, or for 30 years. So what we see oftentimes is the shorter end of the curve is uncertain. People don't know what the next 2 years or 5 years are going to look like, but they're pretty sure 30 years from now, things will probably be like back to similar to how they've been. Now, if you get stuck in a 30-year bond and then you're locked in at 3% interest rate, and then it turns out actually for the next 30 years, interest rates are going to be like 7% or 9% or something like that, your bond is going to be basically worth nothing. It's completely useless, worthless. And I say that in comparison to what you could do with a bond now. So, I could have pulled up some actual like info here, and we could do this like a little more professionally. But just for, reference purposes, it's very important to understand the relationship between the bonds first. So, and somebody asked me to touch a little bit on this, so we'll talk a bit about it right now. So let's say we buy. This is really, really important too. And a lot of people, I think they understand how it works, or maybe kind of understand how it works, but are missing like some key principles along the way. If we buy a bond for $100, our principal is always safe. So as long as we follow the rules of the bond, or, the rules of the loan, as long as we do our part and just wait a certain amount of time, we'll get that guaranteed rate. So we don't have to worry about getting the interest rate along the way. And then we also don't have to worry about getting back our money. My bad. I hate this stupid keyboard. All right. So if we pay that $100 and we get this bond and we take it at a 2%, that's going to be our yield. We're basically going to get paid 2%. Let's just skip like, quarterly payments or semi-annual. And we're just going to assume this bond is very, very simple. We basically loan $100 to the Treasury, to the government. We give them $100. Okay. And then in exchange for waiting a predetermined period of time, they're going to give us 2% per year. So if this is a 1-year bond, let's say, we're going to give them $100, and then we're going to get 2% at the end of the year, and then we're going to get our $100 back. So when it's all said and done, you end up with $102. So that's our total. We put in 100, we got 2% for 1 year, we end up with 102. So if we have that same bond and we just wait more years, we end up with more yield. So if this was a 1-year bond, obviously, we'll just put up here that it was 1 year. Oh my gosh. I promise you there's a legitimate reason that every time I hit a key, it will be wrong, and it will continue to be wrong. So just fully expect it. Just fully expect every time I hit any button that I hit the wrong button. Just want you guys to know that in advance. So if we have a second year right here, now I'm not going to compound the interest just because it's not going to make a big difference in this example. But that same $102, we would just get paid another 2% on top of that. So we would get 2% of $102, which is basically another $2. So we just end up with $104. Now where this starts to get crazy is if something goes wrong and we have to get back this principal before the time is up. So if we don't wait the full 1 year we agreed on and we want to get it back, not only are we going to forfeit the interest, but depending on the terms, we may have to pay a penalty. So instead of getting back the $100 plus $2 interest for waiting the year, we might get back the $100 with no interest minus a 2% penalty. So we get back $98. So if you don't live up to any, portion of this, which in this case, your only agreement is just how long you're going to wait, you end up suffering. But as long as you wait through, you get back your principal no matter what, plus all the interest that you were guaranteed. Now, none of this takes into account, real inflation rates and actual buying power of your dollar. Because if you lock it up, for 2% and then there's 10% inflation rate, let's say that $2 that you were hoping to earn so that you could go out and buy, a loaf of bread. You're like, okay, I'll just lock up this $100 for a year. At the end of the year, I'll use the interest, $2 that I earn, and I'll go out and buy a loaf of bread. So you're like, perfect. So you do that, you go out, you buy the loaf of bread. Well, let's say in the meantime, there's 10% inflation rate, and a loaf of bread was $2. And then now, by the time the year is up and you've earned your $2, now it's $2.20 for a loaf of bread. So you're 20 cents short. So you failed to keep up with real interest rates because inflation ate away the additional buying power that you got. So you actually ended up with net negative buying power because $2 would buy you a loaf of bread. By the time you earned the $2, it wasn't enough anymore. So that being said, this is your basic, just super basic as it gets, how a bond works. Now, where the confusion comes in, and this is the most important part to understand is, especially with long-term bonds and the time value of money, because that's where it starts to get really, really crazy. Because if you take this same $100 right here, and then we extrapolate it out times a different percentage rate for a different period of time, it really, really starts to get a lot different. Let's use, again, extremes here. So instead of taking a 2% interest rate, we're just going to use an extreme. Let's just do let's do 20% interest rate. So if we're talking about the difference between a 2% interest rate and a 20% interest rate, by the time that first year is over, instead of having $102, you're going to have $120. So obviously that is a big, big difference. So the problem is the guy who owns this bond when this bond is now available. Because if you know, okay, I have this bond, I have given them $100, I have agreed to get $2 by the end of the year in interest, and I'll have $102 at the end of the year. Here I have $100. Rates are 20% right now, so they're super risky. Maybe I don't get my money back, but assuming I do, I'm going to have my $100 back plus $20. So there's a massive difference between these two. So if you're going to evaluate the price of this bond or the value of this bond compared to the value of this bond, what you're going to do is you're going to compare the interest rate you would earn plus the principal to get the total amount that the bond is like worth to you. So in this case, if you bought this bond from someone, the value of the bond is $102, or the price of the bond. What you're going to get for it might vary because of that. And here, that $100 bond is worth 20% interest, so it's worth $120 at the end of the year. So there's an $18 difference here. So if you have the same $100 now, and you have to choose where to invest it, and your two options are a 2% bond or a 20% bond, and you say, well, the 2% bond, I'll have $102 at the end of the year. The 20% bond, I'll have $120 at the end of the year. It's an obvious choice. Of course, you're going to take this one, unless there's some sort of risk in here that's just, oh, well, surprise, the 20% bond is in Venezuela. Well, let's just say two equal products, the only thing being different, the percentage rate. And that way we can essentially look at what it would look like to be a bondholder from when rates were basically at zero compared to what it would be like to be a bondholder in the era of Paul Volcker when, rates rose as high as 20%. So it's easy to just use those examples. So now when we use these examples, if I want this $120 bond, but let's say I already bought this bond for the $100 and it's going to be worth $102, I know that I could earn $18 more if I just got out of this bond right here and got into one of these bonds right here. Let's say it's day one of, the 1 year cycle. And let's say we just bought the bond for $100. And as we're walking to our car, getting ready to go home, and we got this shiny new bond in our hands. Obviously, this is a hypothetical situation. It'd be more like sitting on your computer and you just, pulled it. But let's just say, so you're walking back to your car, and then all of a sudden, you see the sign out front changes, and it says 20% interest rates on all bonds for the rest of the day. And you're sitting here looking at this 2% bond, and you're like, what the hell? Well, why don't I just get rid of this $102 bond, and I'll buy one of these $120 bonds? And you're like, sure. So there's some guy in the parking lot, and he's like, hey, I was getting ready to go pick up a bond, actually. I'll buy that bond off you. And you're like, okay, great. How about $102 for it? Because that's what it's worth. The guy's going to laugh at you, and then he's going to turn around and go get in line and buy the $100 bond and, get the $20. So you have to sweeten the deal enough that it's worth it for this guy to buy your bond instead. So the way you do that is by charging less. So you essentially take a hit. So at what point in time does this situation become break even? Well, if this bond is worth $102 at the end of the year, 100 from your principal, 2 for your interest, and this one's worth 100 from your principal and 20 for your interest, 120, you have to sweeten up the pot enough that it's worth it for someone else to buy it, and it's worth it for you also to hold it. So what you look at is the difference between the two, which in this case is $18. So in all reality, look at per $100 invested, not necessarily the price of the investment itself. Because if you bought a bond for $50 versus a bond for $100, you could just buy two $50 bonds, and it's the equivalence of buying one $100 bond. So don't look as much at the purchase price. Just figure that out by the 100. Look more about what the actual yield is, including your return of principal. So in this case, it would have to be an $18 difference. So depending on how you do this, essentially, what it would come down to is, hey, if I'm going to buy this $102 bond off of you, the 2% bond, it's got to make up the difference of the 20% I would be getting in interest. So let's just say I'll pay you $18 less for this bond. So essentially what you're talking about is, now the 18% difference at the end of the year is going to be just paid out in advance. So now instead of that $102, that you expect to get for the bond at the end of the year, you would immediately take a loss of $18. And then you would now have, instead of having your $100 you started with, you would have $82, and then you would put in another $18 of your money, and then you would buy the 20% bond, and then by the end of the year, you would basically break even. So essentially, for you to benefit, you need to sell the bond somewhere in between $100 and the $18 you're missing out on. And for the other guy to benefit to where he'll even buy the bond from you, it has to be somewhere between $18 cheaper or more, or else he'll just go out and buy the 20% bond. And then when you extrapolate that, because obviously if you're holding a bond at 2% and then new bonds are issued at 20%, you're going to be sitting here holding this thing thinking, wow, what a piece of trash. I wish I had the other one. But you know that you don't have to lose out on that $18 in principal by just selling it right now. You can just wait till the end of the year, get your money back, and then buy one of the good bonds, assuming they're still available. But the time value of money kicks in again. So now when you start extrapolating that out by, years, and say you're locked into a bond for like 5 years or 20 years or 30 years, when you start extrapolating out the interest on these things, it really changes. Because again, it didn't make much of a difference here with the 2% interest rate, 102 versus 104, there would be a couple pennies at the end as well. Here, if you have $120 by the end of the first year, and then you get another 20% on top of that, that's going to be another $24. So now this bond at the end of the second year is going to be worth $144. So now you have your $120 bond and you have your $144 bond compared to your $102 bond and your $104 bond. So now, again, this is an extreme example, 2% versus 20%, but we can see how extreme this gets on longer periods of time if you're locked in at a low interest rate and then actually interest rates go higher during that period of time. It can make a massive, massive difference. Because here, the difference is $18, which is definitely a big deal. Here now the difference is $40. So here it was $18 per year. Here it's $20 per year, and it's just going to get bigger and bigger and bigger, the gap. So if you look at this over time and then you say, okay, let's say the exact same scenario we talked about. We're walking back to the parking lot with our bond, and now they're like, hey, 20% on 2-year bonds, and you're locked in at a 2% on 2-year bond, and you decide you want to do this trade, and, you're still at the beginning of this time where you're locked up now, and you have to either say, take a penalty to your principal, or if you need to sell your bond on the open market, you sell your bond. What's the difference? You need to arb that $40 difference on a $100 investment. You're taking a massive hit. So over time, this keeps getting bigger and bigger and bigger, and the difference keeps getting, obviously like more massive. So if a long extended period of high rates goes on for long enough, it really crushes the bond market, because the whole entire time you're sitting on these bonds that are trash, paying you 2% a year, when you could be sitting on bonds that are gold, paying you 20% a year, or, even if it's 4% or 8% or whatever. It's a massive, massive difference. And that's what causes, as rates rise, this extreme weakness in the bond market, it's essentially like the difference between what you're going to get versus the opportunity you're going to miss out on because you entered into, basically a bad contract. So that being said, hopefully that helps to break down the relationship. Now, at any point in time, you can always just wait the design, like the agreed amount of time, and then just get back your principal. So you don't have to say, on day one of your 2-year lockup period, oh man, I've got this $100 locked up and I'm only going to have 104 at the end of 2 years versus, I've got this $100 locked up and it's worth 44 by the end of the year. So I'll just immediately sell my bond to this guy in the parking lot for the difference so that I can make that extra $40. So, I'll just give him my bond for $60 right now and take a $40. No, you're not going to do that, obviously. You can just take the penalty on the actual bond itself or whatever. So there's always going to be other options. It's not just like, oh, you're just screwed now because you bought this bond at a bad price, but it's more about missed opportunity. And that's what would drive people essentially to sell their bonds or, potentially like liquidity issues, something like that. Or, if they're afraid that they're not going to get paid back, etc. So that being said, back to the TNX. So TNX is still very strong in the bullish control zone, all green histograms, blue slope line, above the 200 exponential with blue slope, above the 200 simple with basically a flat slope. And, arguably right now on the monthly, we already basically gapped up slightly and then moved to the upside. So, if we were to just close right now, we would be closing a new monthly high. So that's just the basic rundown. Obviously, we see on the 210 spread, the 2 year is continuing to surge to the upside. The 10 is still kind of batting its head on the previous year. So the 2 year is already confirmed breakout of the previous high from 2018. The 10 year is still kind of bumping its head around there, at least until Powell comes out in the next rate hike. So, and, we could look at, well, we don't really need to look at like the actual bond market because we know the relationship and why that's so important. If the TNX chart is still strong, your bond charts are, probably going to be weak. If we're looking at TNX chart going into potentially like multi-decade bull run, we know, probably bond market is going to be really, really bad. And the reason it's going to be really, really bad is because there's a bunch of people that have a bunch of bonds that are paying trash when they could have a bunch of brand new bonds that are paying much, much better. And if we continue to see, the Fed funds rate go up, we would see the issuance on new bonds, 2 years, 10 years, whatever, all continue to rise as well, making older bonds less and less desirable because of that time value of money. All right, so on to oil. So we got this breakdown on oil. A lot of weakness. We're back testing the breakdown as resistance now. So obviously that was our support level. That was our bottom. And, now it's basically acting as resistance here. If we don't reclaim this level, if we don't get back inside the descending channel, we're going to break down. Obviously, we're not far off of our next target here. We did bounce some key levels, the ascending support, the descending support from the top of the channel. We'll see what happens here. Typically, you break down, you back test, and then if it fails, you go lower. So still expecting around like 70s for oil. So. All right, and then next we have Dow DIA. So on the daily, not a lot has changed right here. So we essentially got, we talked about potential for another short-term bottom. Obviously we have the long-term bottom down here, the lowest low that we put in this cycle. We had a nice powerful uptrend, and now we sold off pretty aggressively back down into the bearish control zone, back down to like the -4 zone right here. We still have a blue slope. We have a couple green histograms now. We're moving up. We're taking back the 8. We're back testing the 21. We're still very clearly rejected off of the 200 exponential and simple. So the real question is right here, essentially, we know what just happened. We basically came down, put in a low. We came all the way up to the 618. We came all the way back down to the 236. And this is the scenario we talked about. If we hold this ascending support line and the 236, we have a higher low. Now we have the opportunity to come back up here and try to put in a higher high and begin an uptrend. So that is still 100% in the cards. There's still a very viable possibility that we come up here, we break through the descending red resistance, we break through the 618, we put in a higher high, and then we have a low, then we have a high, then we have a lower low, then we have a higher high. We start threatening the all-time highs, potentially going to new all-time highs. and the melt up continues. That is always, always, always a possibility. Now, is that likely? Well, you have to determine that for yourself. I mean, when we look at the daily, you say, well, this looks like we're ready to rip. We could definitely keep going here. I mean, it sucks we're under the blue slope line here, but, maybe we get back up there and reclaim it. We're still in the bearish control zone, so obviously that's not great, but, we're close to exiting it. Maybe get the hard buy signal. Maybe that propels us up to the 0.5. Back test of the 200 exponential. And we put in a lower high there, and then it rolls back over. We don't know. Obviously, the best way to determine that is, well, let's look at our daily chart. We're below the 200 exponential and simple, and they have negative slope lines, so the trend is bearish. So the likelihood that this was the bottom, this is our lower high, and then we're going to now break out to the upside is less than 50%, because obviously it's counter trend. So we can say it's around, 33%. Same thing right here. We have a bunch of red histograms, and now we're flipping some green histograms. So again, it's showing us we definitely have some room for upside, but we have strong resistance above our heads. And then same thing again with the stochastics. We're at the bottom of the range. Obviously the bears are still in control, but there's some room to run to the upside. So how do we determine if the daily has some potential to be bullish? Well, we'll look at the weekly. How's the weekly look? Well, the weekly bounced off of 200 exponential and simple, came up here and had a massive failure on the 821 cross, came back down and started to reapproach the bottom. We got to that key support level, the Fibonacci, and now once we get to that support level, we're going to try, the bulls are going to try to basically buy up and assume, okay, this is it, this is our higher low, and now we're going higher. So the first thing we would expect to happen is a back test of the 8 and 21, and then see what happens there. If we close right where we're at right now, that's not a bad close. I mean, basically, didn't quite bullish engulf, but almost did this past weekly candle. We're back testing key resistance and maybe having another go at trying to cross the 821 back to the upside. So there's some potential here. The Stochs are still angled to the upside, which is okay. Green histograms, rejection off the slope line, and then, potential multiple green histograms again. So could we get back above the slope line? Could we get back above zero line? Could we flip the slope line over blue and then, cross the 821 bullish and then start into a new uptrend? It's definitely a possibility. And then if we go over to our monthly chart here and we say, okay, how's that monthly look? Well, we look pretty toppy here, a bunch of red histograms, red slope line, nothing bullish on the TDMACD at all. And then we look at the Jewel Thief and we say hard sell signal, left the bullish control zone, powerfully angled Stochs to the downside. Well, nothing bullish there, obviously. And then we look at the TD Master and we say, okay, we're above the 200 exponential and simple on the monthly. That's still good, but often doesn't give us viable trading methods. What about the 821? Well, we're still below the 8. We're below the 21, and they're very close to crossing. So this is, again, here we had a powerful red candle. Then we attempted to cross them back up. We saw a continuation, attempted to cross them back up, got completely rejected and came down here. So now, again, we're trying to bounce back up here once again. And then, if we close at or below 325, which is the key level we've been watching, we would expect continuation to the downside as a rejection from that level. If we get back above it and start closing above it and we avert this cross, there's no reason not to think we start threatening the previous highs right here. But again, it's still way too early for me to start getting bullish on the stock market right now. Now, could we see another, what are the situations that could happen? Well, this just melts down by end of day and it doesn't really change anything. It's a little less bullish, but, if it just went all the way back down and flipped red and just closed where it opened, doesn't really change anything, bullish or bearish. What if we get another big green? What if we close right here and then we get green continuation up here? Again, doesn't really change anything, bullish or bearish. The key level and the most important thing that needs to happen is we need to cross the 821 back bullish, which is going to probably take a few days, even if we have some nice bullish action. We need to get back above the 200 exponential and simple, and then we need to flip them bullish. If none of those things happen, it's almost impossible for me to get bullish on the market, because I know that in order for anything bullish to happen on the actual chart on price action, those things will have to happen. So that's what I'm looking at, and that's what keeps it so simple and keeps me away from, feeling that FOMO. Same thing with SPY. We came back down, again to that same 236, found support, back test at 382. Next is the 0.5. Arguably, if we take out the 618, then we can start, getting bullish on this thing. But we're seeing a reacceleration to the downside and clear rejection off of the stochastics. and then again, or off of the moving averages. And then again, when we look at the weekly, what did we do? Well, we got clearly rejected, and now we're back testing the rejection. And typically what happens is you try to reclaim an area, it fails, you back test it one more time, it fails, and then you continue to go lower, eventually back test the bottom of the range. So we talked about this on the last stream. Right now, when I look at these charts, I say, well, it's a coin flip right now. Likely we see a bounce off this, but if we don't take out the high here, it's impossible to get bullish. And then, you know, same thing here. If we just started to sell back off now, if we don't take out the low, it's impossible to get any more bearish than we already are. So really something has to change on the chart. And right now, you know, the ball is in the bulls' court. The bears are in clear control. You know, the bulls have the ball right now, but they have to do something with it. The bears are up 30 points to nothing. So if the bulls just stall, the bears end up winning. Same on the monthly here, just nothing to get bullish about. You know, basically just another back test of resistance. All right, so we're going to, Q-wise, it's pretty much the same thing. You know, we're basically just seeing the exact same move on all of the major indexes. If we go over to SMH, semiconductors, again, we revisit the lows a little bit closer here. We're having a little push up here. It looks a lot less, you know, bullish when you look at a chart like this, because the move after it topped out, the back test itself was much less strong or much weaker. So it doesn't give you the same level of confidence. Because if I showed people this chart, they would say, oh, I don't know, this doesn't look so great. But, you know, if we show people the Dow Jones chart, it's like, well, there's still some potential. You know, we could still go higher here. You know, if I show people the Apple chart, it looks bullish. You know, if we show people the, you know, I don't know, Meta chart or something like that, it's like, well, I don't know, or Nvidia. So semiconductors, you know, very important sector to watch, but again, not particularly, not looking nearly as bullish right now. And then again, just to kind of throw up the longer term charts as well, as we are wrapping up the weekly close. We see the weekly, you know, is basically bouncing the 200 exponential and then coming straight back down to it again, and a very clear rejection. This does not look like all of a sudden this is about to turn around. Now there's potential with the higher low, obviously, but it looks actually like it's getting ready to roll back over and go to new lows. So which one is telling us the truth? Is it the strongest 30 companies in all the U.S. economy, or, you know, arguably like biggest, however you want to, the Dow Jones, or is it, you know, the semiconductor space? Are the top 30 companies going to give you a broader, clearer picture of what to expect from the entire market than some of our other indicators? Probably not. Probably not. So if we look at the monthly on semis, you know, we have crossed to the downside here. We still have 21 days. If we pushed up here and just stopped at 235, we could avert the cross. You know, obviously it wouldn't avert right away, but, you know, it would possibly even flip back green. So give or take a month on this to officially confirm the cross down. But we know the last time this cross down happened was in 2007. So, you know, this is pretty important. Now, we did have a couple close calls, but we averted those. Monthly indicator oscillators, though, not looking good. Not looking good. So, you know, we get these nice little pumps or nice little moves or whatever, and it's fun to take advantage of them. Sometimes we'll sit them out. But the most important thing is, especially when we anticipate them happening ahead of time, not to all of a sudden be like, oh my gosh, it's pumping, and start feeling like the FOMO. I mean, we were talking about, in the last stream, we literally talked about how I was expecting, you know, a $700 candle. And if we break this down, real simple. Actually, let's just go to our spot chart and look at Bitstamp. You know, and obviously this is the importance of a real-time move versus not. You know, right here is what I was looking at on the hourly. We start to see the 821 cross. As soon as the 821 cross happens, you know, I posted a message in the group, you know, get ready or watch out for this $700 candle that's about to hit. Obviously, we got a little bit of an underperformance initially. It was like, I think 500 at one point in time. 456. So it pumped up $456. I was expecting it to pump all the way up to the 200 exponential and simple on the hourly. Instead, it just kind of went sideways for a bit, and then we saw the continuation. Obviously, we saw a substantial continuation after that. Well, why is that? You said 700. You know, I wasn't expecting this. Well, there's lots of reasons. But first off, I also pointed out in the group as well, this cup and handle pattern. And, you know, obviously the real time, you know, to the people who utilize it, you know, real time, like updates, whatever I'm seeing in the group is obviously pretty important. What am I looking for here? Damn, what did I just say? Oh, what, cup and handle, right? Where the fuck is the rounded one? I'm going mad. This is by far my least favorite tool. So we pointed out this in the group essentially, and let's turn this a different color. And this was basically, you know, the catalyst after that initial push up for potential continuation. You know, we started to put in what amounted to, you know, a sort of cup and handle pattern right here. Now it's not textbook beautiful, but it started off as a little descending channel, you know, etc. And then we had a clear resistance right here. So when we came back up to that resistance, and again, we talk about the $700 candle, obviously, you know, was the potential catalyst or the potential initial move to which all of the continuation could potentially be built off of. You know, we're basically looking at, you know, a breakout from the rim of the cup, and that would give us essentially a target of 20,386. So from that 20,386, you know, the initial push up gets us to 200 exponential and simple. Then we see continuation to the macro fib, and then we see continuation to the measure move of the cup and handle. And then, you know, obviously as we continue looking at our other time frames, well, once we got past what we were looking at on the hourly chart, we start looking at the 4-hour chart, and it's like, okay, well, this is the back test of resistance. So this is basically a spring. This is the cup and handle. This is the breakout and back test of resistance. And then we already made it back up to 200 exponential and simple on the daily. So the next reasonable target is the 200 exponential and simple on the 4-hour. I'm sorry, I said daily, I meant hourly. So here we hit it on the 4-hour, come up here, and now we're just below the 200 simple on the 4-hour. And then also we have this other cluster of resistance. So is it crazy right now to think that the next target to the upside is going to be the 200 simple at 21,632? No, I mean, it's expected. It's obvious when you look at it like this. And that's why I love these indicators, because you can literally look at the 15-minute, the 1-hour, the 4-hour, and the daily, or whatever time frames you choose. Those are the 4 that I always look at. And you basically get this picture. And it's like, okay, you know, once we take out all the important levels on the 15-minute, we'll look at the hourly. Once we take out all the levels on the hourly, we'll look at the 4-hour, etc. So we're back testing that key resistance. We're back testing some key moving averages now. We talked about the importance of this 4-hour 821 cross. We saw after that cross took place, we saw, you know, a few $1,000s in continuation. So, you know, obviously that was the key thing to look out for. And, you know, if you're watching on shorter time frames, if you saw the cup and handle, if you saw any of these things ahead of time, you know, obviously you're able to capitalize on this move very nicely. And I hope a lot of you were able to. And, you know, not to call anybody out or anything, but, you know, people were talking about, you know, potentially building a short position or shorting the retest of the lows down here, to which I said, I don't think it's a good idea to short, you know, the key support or the only remaining support. You know, we came down here and basically closed the lower low on the daily. So obviously that's bearish. It's a new lower low on the cycle for daily closes. That's bearish. But we're at support, and this support was here 1 time, 2 times, 3 times at work. So we come down to it the 4th time. Sure, we might break through it for a little bit, but you know, you can't look at supports as like, oh, if we go past it by 1 penny, it's broken and that's it. Sometimes you break through them and then you immediately reclaim them and then consolidate, and then they act as they were supposed to act initially. But sometimes that initial momentum or the big wave of selling or buying is enough to break through it initially, but it doesn't mean that, you know, like your retaining wall is compromised. It just means a really big wave hit it. Things got a little messy for a minute, but the retaining wall is still there. Everything's still normal, still going to act as support, etc. So that's what we're seeing take place. Obviously here on the daily, being above the 21 is a big deal, above that 20,450 level. Crossing the 821 back bullish would obviously be a big deal. Now, is that going to happen? You know, I don't know. We'll have to wait and see. Obviously, you know, we don't know what's going to happen. It's a pretty powerful knife right here. We are leaving the bearish control zone, which obviously is a good thing. We talked about another catalyst on shorter time frame here. I've talked about this quite a few times. We basically had some pretty substantial divergence taking place. So we have a low right here, which a massive low on the histogram. Then we have a low right here with a substantially less, you know, invasive low here. And then here we have a third low, each higher than the previous one. And here we have a low, a lower low, and a third lower low. So we see 4-hour bullish divergence very, very clearly displayed on the indicator oscillators. If we zoom in here and take a look, here we see our initial low, our higher low, and our higher low once again. So again, we see triple bullish divergence right here. And then we see a bullish cup and handle pattern. And then we see a bullish cross on the 821 on the hourly, followed by a cross on the 4-hour, followed by continuation, followed by back testing key levels on the daily. I mean, the same strategy on shorter time frames just builds into the same strategy on longer time frames. And that's what's so beautiful about it. People always ask me, they're like, oh, can I use these indicators on the 1-hour chart or the 1-second chart? Sure, you can do whatever you want with them. And if they work, if the strategy works on shorter time frames, by all means. You know, if you have to alter a couple things on the 1-second time frame or whatever you crackhead traders out there are doing these days, by all means. You know, the reason I like to use longer time frames is because the amount of time and effort that I have to put in compared to the yields I get for that effort are the sweet spot. I know that I could trade a shorter time frame probably and make more trades and do slightly better. But, you know, if I'm trading a 15-minute chart all the time versus trading a 4-hour chart all the time, how much extra work am I putting in and how much extra yield am I gaining? Because that's what it really comes down to. You know, how much are you getting paid for your money to put in that extra work? All right, so that's our basics on Bitcoin. Obviously, you know, people excited for the move that's happening or whatever. Look at the big picture here on the daily. Does this change the big picture at all? You know, this is our macro high. This is our macro low. We just put in a new low on the close, and then we had, you know, a 10% pump since then, which is nice. It's definitely a nice pump for sure. 10% is always good. But I mean, is this like a, oh, now, like, you know, the downtrend is no longer intact. You know, it has been destroyed and now it's, you know, bull's time to shine. No, I'm not saying anything even close to that. The thing we need to pay attention to, obviously the 4-hour cross is good. The backtest of the 200 exponential on the 4-hour is good. But now we need to flip them blue, get back on top of them and consolidate. And we need to do it for a long enough time that the 8 and 21 on the daily cross bullish. So the key area to hold is 20,500. If we spend long enough time above that, the 8 and the 21 will cross back up. And then, you know, we'll look for a counter trend rally, potentially back to like 28.6 or something like that. But, you know, I talked about it specifically in the group about how when we came down to the bottom right here, the last thing I was going to do was be shorting. If anything, I would be down here buying support. And then the next move I would expect is a push all the way back up to the top of the range, to which case I would be selling resistance. So you guys know I sold into the 25K pump up here, basically the absolute top, which played out nicely. Obviously, it was pure luck. But we sold into a 25 pump, you know, took advantage of the downtrend, obviously, by not, you know, taking those losses. And then when we come back up here again, we get back to that level, I'm going to look to sell into like that $23,000, $24,000 area, assuming that we're either trading in a sideways channel or we're trading in some kind of like descending triangle or just some sort of pattern, essentially where we have the same lows down here acting as support. And then we would either expect the same highs or slightly lower highs or slightly higher highs potentially be acting as resistance. Now, I don't know which one it's going to be. I know if we come up here and put in a lower low, it's going to look bad. If we come up here and we double top, it's going to just look like a sideways channel and it's like neutral bad. And then if we take out this high right here, you know, it essentially looks good. I mean, it's still bad because we're below the 200 exponential and simple, but likely if we take out this high at like 25K, if we go above 25K, there's like a wick basically in recent history stopping us from pushing up to like 28K, and 28K is the 200 exponential and simple. So I know what you're thinking now. So are we saying that the next target to the upside is 28K? Sure. The target to the upside on the daily that would look more bullish and put Bitcoin back in line with the rest of like the assets on planet Earth that rallied up to their 200 exponential and simple would be 28K. But in order to get to 28K, you know, we need to get through 23K and then 24K and then 5 or 6K, etc. So there's still a bunch of steps on the way up right here. There's definitely potential to push back up and put in a higher high from the low right here. But for me, right now, you know, there's obviously plenty going on this chart. We don't really need this channel anymore. We can get rid of that one. This could stay for now. So let's just use this fib basically as our channel. So, you know, we know obviously there's a little wick down here, but basically this yellow line right here, you know, that's our bottom of the line support. That was our line in the sand we talked about. And then we had, you know, paid attention to that low. So obviously we pushed slightly below that low. Not enough to really matter. Enough to put in a lower low, but not enough that it was like, oh, it's just going to zero now or anything. Obviously we expected that to act as support. That was also the completion of the measure move from the breakdown of the channel. So we've done that. So now the next thing to look out for is basically, you know, the resistance at the top of the channel. So if we expect this to hold as support, we can turn that one blue and say, okay, that's our bottom of the channel right there. And then if we just expect the top of the channel to hold as resistance, you know, we want something basically along the lines of, you know, that right there. And that will be our resistance to pay attention to. And as long as we're operating inside this range, we would expect to continue operating inside the range. So what happened with this recent move up here? Well, if we were using the actual channel tool, we would know that this green line right here is basically the heart line of the channel. You know, if we use, and I can actually do that really quick. So if we just take, oh, realistically, I should have done it the other way, but that's fine. You know, this is our trading range now. Okay, cool. So, you know, we're back up at the middle of the trading range. That's our heart line right there. So while we're trading, what the? God damn you, channel tool. You would think for how much I use TradingView, I would be a little more fluid at it. But damn if we don't fight about every little thing. All right, so we basically have now this channel that we're operating inside of. And as long as we're operating inside this channel, we would expect to continue operating inside the channel. So again, you know, what's the move I'm expecting right here? Well, you know, probably as high as 24K. What's a key resistance along the way? Well, probably the heart line and the macro fibs. You know, and then when we really zoom out and look at this, matter of fact, when we really zoom out and look at this, and we look at where our fibs are and, you know, our potential path that we've been talking about for, you know, how long right here. Well, here's our peak right there. We come down, you know, to our 236 on the initial move down, then put in a lower high. Then we break down here and we come down to our 382s, and then we push up and start to put in a lower high, threaten the lows. Could we still see continuation up here to backtest the 200 exponential and simple on the weekly? Could we still see $28,000 Bitcoin? Well, we know that. We know there's a possibility that we still come up and complete the 4 right here. Now, there's also, obviously, with the amount of weakness we saw and how low it dipped, there's also a possibility I was a little too bullish thinking it might come up here. And, you know, I've never been accused of that before, so this would obviously be the first time. But essentially, you know, this would be our 5 waves down. And actually, this looks pretty constructive. So it wouldn't surprise me if this was already our high. And actually, we're just going to put in a lower high and then come down to our lower targets. Wouldn't surprise me at all. Now, that does not have to play out. But, you know, obviously, it would make perfect sense if it did. So we see these macro fibs over here. We backtested the initial 382. We have another 382 slightly above it. We have our short-term fibs here as well. We have the longer-term targets. Nothing has really changed. We have the descending resistance, yellow line right here, which would be potentially where we would go up to. So when we look at this chart, you know, nothing has changed. You know, we came down here, threatened the lows, tried to have a reaction rally off the lows. Haven't really gone anywhere yet, but, you know, there's potential for continuation. Bunch of green histograms, hard buy signal, left the bearish control zone. You know, we have a lot of resistance right above our heads. So obviously initial resistance would be the 8. Then after that, the 200 simple at 23,000. Then after that, the 200 exponential and 21 at 26,341, you know, which would obviously be a slightly higher high and potentially take us up to that, you know, 26 to 28K target. So again, Bitcoin's still doing, you know, that's the beauty of having plotted out all the paths ahead of time. You know, we basically have a map and there's nothing written on it. And we have where we're at now. And then we have a bunch of just destinations. And we're like, okay, where are the likely areas Bitcoin could go to? And then that way we plan out, you know, 2 or 3 key routes that Bitcoin might take. And then as Bitcoin continues to do things, it might invalidate one of those routes or 2 of those routes. And now it's very clear what the third route's going to be. And then we have to go back through and do the same thing again and make sure, hey, you know, so far we've been really, really right about everything Bitcoin's done, you know, with the, you know, expanded flat, higher high, double top, rolling over, 5-wave structures to the down. I mean, it's been playing out beautifully. But at some point in time, it's going to diverge from our path. So we continue to have new paths available for any time it decides to diverge. Whenever it decides to like choose its own adventure and go a different route. And that's exactly what's happening here. So if I was going to be super bullish right now and, just go full bull tard, like a lot of the crypto space, because, we went up 10%. That's a huge deal after just getting crippled every day. 10% move is nice, always. Especially in a short period of time like that. And the beauty of crypto and what it does to you is, it does these big moves in a short period of time. Like crypto was looking pretty weak up until recently. People were literally saying, I'm going to short it right here. And it's like, don't short support. Don't short support. Buy support, sell resistance. Like, how good are the market makers? How good are the whales that at the bottom, at support, at the strongest support, the only support left, they had the market convinced that we were going lower and now was a good time to short it. When in all actuality, it was the best time to buy it. And, there's proof because it went up 10% instantly since then. So how good is the market? How good are the market makers at using psychology or key levels or price action to literally paint the tape to make people do the absolute worst thing? Because if I literally showed you a chart and there was one line on it right here at the lows, and then you see us come down to the lows right here and I say, hey, would you short right here? You'd be like, no, because there's support. But all the other stuff going on was enough to confuse people that know better than to short support, that know better than to buy resistance, to think now is a good time for me to short. Just think about that, because that's what you're competing up against all the time. So initially, when you start trading or you start learning, more in-depth stuff or whatever, there's like this weird process you go through where like you essentially have to like train your brain to kind of do the opposite of what it tells you you're supposed to do. Because you come back down to key support and it looks like, oh, we're going to break lower. I should short it. But in all actuality, you're like, no. Actually, this is the best time to buy and the worst time to sell. So then you do the opposite of what you think you should do. And then it works. And you're like, oh my gosh, that's amazing. And then you keep doing that a couple times. It looks like you're breaking out to the upside. Say we come back up here and we start threatening 24,500. People are like, oh my God, I'm gonna long it right here because we're about to break out. We're going to new highs. We're back in a bull run. And then what happens? We get rejected and go back to the bottom of the range. And you think, oh man, so I'll just do the opposite. When I think I want to long it, when I start feeling the FOMO, I'll short it. And when I start feeling like shorting it, I'll long it. And sure, that works for a little while. And then after a while, you start confusing yourself because you're trying to like counter trend trade your old brain, but your new brain now knows, hey, that's not what you're supposed to do. Do this instead. So then it creates more static. So it's really good, the psychological aspect of it, but you still have to understand why you're doing these things, why the market is doing these things, and why you're counter trend trading the market or what you're like seeing on the charts. And obviously this is in no way an insult or attack at any particular person or anything like that, or people that were shorting, that just basically got stomped out, whatever the situation. It's more just to help you learn and understand the psychology behind it and understand that if you were feeling like you should short down here when we broke to new lows, you were feeling that way for a reason, because that's what everyone was feeling, because essentially that's what the market does. It trains you to do the wrong thing at the wrong time. There's a reason people always sell the lows and buy the highs. There's a reason. It's because of the psychology of it. It's not just like, oh man, there's another sucker born every day. Like, I mean, it kind of is. Because you're a sucker by not educating yourself. But the truth is, the markets do this intentionally. There's someone shaking you out. Like naturally, if you go to a new low, it's like, uh-oh, we're just going to keep going lower now because we just put in a new low. So that's the worst time, to sell, because they're tricking you into thinking. They know that you're thinking, if we break to new lows, that's where my stop loss is at. I'll just get taken out of my stop and then I'll, be out of this position. And then all of a sudden the market goes in your direction. And the same thing with new highs. Here, when we had the high at like 64K or whatever, if you don't think for a second that the second we took out that 64K high, as soon as we closed the daily above that, or as soon as we wicked above that, if you don't think that that was immediately a bunch of shorts, all this price action right here is probably shorts getting closed out. 90% of it. Because everybody says, okay, we came up here, so if we go above that previous high, I don't want to be short anymore because it's a blue sky breakout and we're likely to see continuation. So what happens? The market makers move the price up there to where they know everyone's stop losses are at. So all the shorts have stop losses above the previous all-time high. We come up to that level. The short stop losses get hit, which if you're short and your stop loss gets hit, you become a buyer. So then the buying pressure continues to push it up higher and higher to squeeze out more shorts. And then eventually there's no more actual buying pressure because this move was all just designed to essentially just gain more momentum and come back to the downside. So then once we take out all, the shorts right here, they all have to buy back in. It pushes price up or whatever. And then the real shorts come in, the real selling comes in, and then all that extra selling pressure, including the people that were actually planning to sell, but then all the people that were short on the way up that got stopped out, now they're like, oh great, now we're going to go down. So they have to re-enter their shorts now. So now they were sellers and then they became buyers and now they have to sell again. So that provides 3 different events of liquidity. You are a seller and you become a buyer. Then you are a buyer and you become a seller. And then the price continues to the downside. So you have 3 different liquidity events from a single trader. And then multiply that out by everybody in the market. And that's why you often see, volume spikes at lows and highs, because that's all the extra volume taking place as there's buyers competing against sellers, competing against buyers, competing against sellers. And some of those sellers were buyers and some of those buyers were sellers. And there's just a whole clusterfuck of price action taking place at those levels. And then eventually either the bears win or the bulls win or, whatever. So that's the whole psychology behind it. That's what's going on here. And that's why the market essentially takes advantage of you. Now, if you're a super bull right here, you're going to say, well, this is a double bottom. And we've double bottomed a lot in Bitcoin's history. So if we double bottom here, we come up, we take out the neckline, we'll get the measure move after that. We start threatening, the 30K level or whatever. And then we end up going into a bull market, which for sure could definitely happen. That would be the bullish case. But there's still a lot that has to happen before we get bullish here. When do I start legitimately getting bullish on these markets? What is my line in the sand? I know you guys are curious of that, but like not curious enough to ask, or like just, don't want to feel dumb or whatever. But you should always have a line in the sand. Like, hey, when does this change? When am I wrong? When does my thesis change? And you guys know for me, it's on the daily. My main gauge is the daily. And the most important thing on the daily is we just got to get back above the 200 exponential and simple and then flip them blue. That's it. So 30K. And you're like, well, we're at 21K now. So you're going to wait till 30K to get bullish? You're going to wait till we put in a 50% move up? You're going to wait till we're up $9,000 and then you're going to get bullish? Well, I mean, we can get bullish when the 821 crosses, which we will on the daily, which will likely happen sometime in the near future, assuming this sticks. So really, where will we get bullish at? Well, let's just assume that Bitcoin does what, we tell it to do, which it probably will. It's probably going to close somewhere around this level, and then it's probably going to have some kind of back test to about 20,500, and then at about 20,500, it's probably going to chop around, go up, go down, and then we'll see some kind of wick to the downside, and then it'll probably get bought up, and then like a day or two later, we'll get the 821 cross to the upside. And then at that point in time, we'll probably be somewhere around 21,000, at which point in time, we'll enter at 21,000 with part of our position with the 821 bull cross, with likely target up to like 24,000, possibly 26, possibly 28 or 30. And then as each of these things continues to happen on different time frames, it'll look more and more bullish. And then eventually we'll get above the 200 exponential and simple, they'll flip blue, and then we'll say, okay, now we want to be in with the majority of our position, and then obviously once the 200 exponential gets on top of the 200 simple, then we say, okay, so we went from a prolonged downtrend, and now the 200 exponential is crossing above the 200 simple, and now they're both blue and price action's on top of them. We're at the beginning of an uptrend. And that's what I'll get excited about. And that will be my line in the sand where I'm like, okay, now's the time to get bullish. And just a quick reminder, this is super important. Just a quick reminder, that was on the daily. We were talking about that happening, just for like, to reinforce my point. This is a long downtrend on a monthly chart. We're back on the DXY. And then the 200 exponential flips bullish right here. And then we're on top of the 200 simple and the 200 exponential, and they're both bullish right here. So that was a key point. And then, we get that back test like we discussed. And then the 200 exponential crosses above the 200 simple, and then both flip blue right here. And we see the process taking place and what happens afterwards. So we can just imagine this same chart and just say, okay, well, let's just imagine this is the Bitcoin chart and what the moving averages would look like without all the price action. And that's all we're doing. It's not like some crazy thing. I mean, obviously we developed the strategy, on our own using pieces of other people's strategies as well, which is what everything is, accumulation of others, knowledge. If everybody had to just start all over and had to invent their own language and, their own, everything basically, the human race would suck right now. But because we're able to use all the past knowledge that's available to us and then build on top of it with some of our own, we can further advance the species. And I'm not saying I'm here advancing the species or anything, but you get the point. So again here, looking at TNX on the weekly chart right here, well, we see when we got above the 200 exponential right here, we started to get bullish. We get our initial back test. Now we're on top of the 200 exponential and simple. Now the 200 exponential is crossing to the upside. They're both blue. We're seeing continuation. So it would be the same thing for Bitcoin. Bitcoin's not some special, unique, asset. It's not some amazing commodity or, arguably security, depending who you ask. It's just one more trash asset in a world of trash assets. And you're like, why are you being mean to Bitcoin? Don't call it trash. It just pumped up 10%, dick. Oh, I fucking hate you, man. That's why I unsubscribed. I'm going to subscribe again and then unsubscribe again just to teach you a lesson. Your net subscribers will still be the same, but you'll see I unsubscribe. Sure, you could do that. Sorry to be mean to your precious Bitcoin or crypto or whatever, but anything that's underneath the 200 exponential and simple moving average with, red and pink downtrend on them, to me is a trash asset. In the meantime, doesn't mean I don't believe in Bitcoin in the future. Doesn't mean Bitcoin can't ever not be trash again. I mean, it can be a beautiful, amazing digital creature, tromping around in the metaverse. But in order to do that, it's got to be above the 200 exponential and simple. In the meantime, it's trash. So let's look at now. We know what needs to happen on the daily. We know what potentially could happen on the weekly. We have key areas to watch, 26K. There's basically like steps every like 2,000. Let's look at our monthly, and then we'll take a look at some of our shit coins as well. I mean, alternative digital assets. Sorry, I didn't mean to be mean. Bitcoin on the monthly. Monthly bear cross looks terrible, obviously, on the 821s. We don't have any populated 200 exponential and simple. We're in the bearish control zone. All red histograms, red slope line. We're below the zero line. There's nothing bullish on this chart, obviously, at all. It's obviously very, very bearish. We're consolidating at the lows. We basically talked about this scenario. We now have a clear low that we have, spent 4 months at, basically. And then we have this clear high and low right here. Now, would you guys guess that that's probably somewhere around the top of the channel? Of course, it's 23,450. So we put the channel at like 24.5. This is at 23.5 based on monthly closes, etc. The most likely scenario, in my opinion, when we're trading inside a range, which we clearly have been for, the last 2 months at least, arguably, this is our 4th month operating inside that range. Part of the month was outside of it. It would make sense that the next move we have is a retest of 24K. Which is exactly what I said in the group in advance. When we came down to hit the lows and people started getting, a little bearish and wanting to short and saying they were expecting continuation, I said, actually, the most likely move is probably a back test of 24K. It's just a return to the top of the range. And so now that we're at 21,331, it's like, well, yeah, definitely seems like it now. When we're at new lows down here, sub 20K, 19K, whatever, it doesn't look nearly as likely. So that's what it's all about. So on the daily, we have a nice green candle right here, a nice push up. We could be like, oh, it's because of XYZ. Michael Saylor bought more Bitcoin. Kathy Woods back in on Bitcoin. Jim Cramer said he actually likes Bitcoin again. Puerto Rico bought Bitcoin on their balance sheet. I don't know what the BS fundamental news articles will say. I have no idea what they're going to claim the reason for this pump is. I would say with pretty good certainty that the reason for this pump is, well, we came down to the lows and we tested those lows and they held. So now we're going to go back up and test some resistance as well. That actually is like why it happened. Now we could be like, well, no, actually, it's because of this news article. Probably not. So we have pretty clear targets to upside. We know the key areas to watch out for every time we have, clear resistance or support along the way, various different moving averages. The next target to the upside is, 21,600. It's a back test of the 200 simple. At that point in time, we probably chop around between the 200 exponential and simple on the 4 hour for a bit and then make up our mind. At some point in time, we probably come down to like 20,500 and, back test the cross, the support, whatever. But if we stay above them long enough, we would expect continuation to the upside. Now, again, though, we do have a ticking sort of, timer scenario. We have another Fed rate hike coming in. So if this entire move in Bitcoin, this massive, massive pump, this super bull pump that has just completely changed the crypto space forever, and now suddenly crypto is awesome and amazing and we're bullish again. If that entire move and that entire thesis, which you would think that that's what's going on right now by the level of excitement of a 10% move, if that's all correct, if all of that is correct, we know that this entire move is based on two things, TNX and DXY. And then if this move is going to be sticky at all, we need to see a breakdown in TNX and DXY, which we actually built a decent case for why we could see that happen and we could see that continuation. So I think we've built a pretty strong case for where Bitcoin could be headed, where stocks could be headed, what the catalyst would be for that to be a sticky and continued move on the TNX and the DXY. And then on top of all that, we have basically, a line in the sand, which is, the Fed funds, the Fed meeting and potential, likely Fed funds hike the next 75 basis points. So if we get another 75 basis point hike, that basically washes out the downside action we just saw in the DXY, because it widens the gap back to where it was between the euro and the Canadian dollar and all the other ones. So we're right back to where we started. So on the price action on the chart, that likely just puts us back to where we were. So that would be a bullish catalyst for DXY, a bearish catalyst for risk on assets like stocks and crypto. So does that mean that the crypto market and the stock market right now are counting for a 75-point rate hike, and that if they get a bigger rate hike, it's bearish? If they get a 75, it's bullish because it's already priced in. And then if they get lower, it's super bullish because it's less and they already priced in more. You could look at it like that. I would say that right now, the efficiency of the markets is very, very poor in comparison. Like typically in the past, you could go decades where you say, oh, the bond market's always right, it's just looking into the future, or the stock market's looking 6 months ahead and that's already priced in, etc. I would say right now there's so much uncertainty and so many just completely contrasting views on completely opposite ends of the spectrum that the efficiency of the market is probably the lowest or close to the lowest it's ever been. We have seen the bond market is always right. People say, oh, trust the bond market. The bond market's always right. Well, how many times have we seen the bond market completely offsides, completely wrong, completely just decimated over the last year? I mean, the bond market has been essentially useless. And right now, when we see what the bond market is pricing in, and then we look at that in comparison to what the Fed is telling us, the bond market is saying, well, the Fed's wrong. So for the last decade or more, the argument has been, don't fight the Fed. And it was always beneficial to us to not fight the Fed because it just meant, hey, the Fed's just going to keep pumping up these asset prices, so don't fight it. Bullish melt up. And now that the Fed is not friendly, now that it's doing, what it needs to do and it's not doing the pleasant, the fun, the bullish things, now we're going to start fighting the Fed. Now the bond market doesn't believe the Fed or thinks the Fed's wrong. What happened to don't fight the Fed? Well, now the Fed doesn't know what they're talking about. So is that because they lost credibility? Is it because the Fed has bad research? Is it because the bond market is prescient and can see the future? Is it because the bond market's mad at the Fed because Jerome Powell's a bitch? I mean, I don't know. I don't know what of those reasons it is, but probably some kind of combination of them. I think definitely the Jerome Powell is a bitch thing is definitely a factor. Now, maybe he'll prove not to be a bitch. I don't think it's likely. I think he's a little pussy bitch. But, that's also my opinion. The bond market might not agree with me. But we know that there's a rate hike coming up and it's probably going to be 75 basis points. And we know that regardless of how the market looks at that, whether or not it's priced in, that is not good for risk on assets. It's not good for housing market. It's not good for leverage. It's not good for any loans that are out there. It's not good for, basically money supply or credit or, liquidity. So without trying to get into this whole weird clusterfuck of what's good is bad and bad is good, and if 75 is priced in and then we actually get 75, then that's bullish because we didn't get worse than, without getting into all that bullshit, because you'll run yourself in circles and you'll never be a successful trader if you always try to figure all that stuff out. The best thing to do is just draw your lines in the sand, figure out exactly what's going on, and then reason through these situations. So if we know we're about to get a 75 basis point hike, very, very likely, and let's just say we get that hike, what does that do to the markets? It closes the gap on the DXY again, so the DXY should strengthen compared to, the other currencies in it. It obviously puts the 10-year treasury higher, because that's essentially based off of the Fed funds rate. So we would expect the 10-year to go higher. So if we know we're about to get 75 basis points in 2 weeks, we know that the DXY will likely strengthen based off of that, or at least relative. And we know that the 10-year will go up based off of that, you know, at least relative, probably around the same amount, give or take. Can we see a sustained rally in asset prices while that happens? If everything that's been for the last like year plus stays the same? No, we can't. We cannot see a sustained rally in stocks, cryptos, or bonds while the yields are going up and while the dollar is strengthening. We cannot. We know that for a fact. So until we either break that correlation or that inverse correlation between, you know, assets and those two, until we bust up the tag team or break free of the tag team, you know, just expect to keep getting bushwhacked. So, you know, am I bullish now after this move? A little more bullish. The 4-hour cross was big, obviously. You know, we talked about the whole bullish case and everything, but, you know, is this just one of these candles before we go lower? Is this just, you know, one of these before we get another big red one that matches it? I mean, I would say probably yes. I mean, look at how aggressive this knife is right here. I don't think this is going to be some super sticky move or whatever. Now, maybe I'm wrong. I hope I am. It's much easier to make money going up. But not the time to just start assuming we're going into like some crazy bull run. I know it's fun when we get 10% pump in a day, especially, you know, when we're positioned for it, when we see it coming, etc. But not the time, in my opinion. So let's look at Ethereum next. Ethereum on the daily. Obviously, Ethereum has been extremely bullish. We were able to cross the 8 and 21 back to the upside on the daily. Obviously, that is good. Tells us we are likely to get continuation, at least another leg up right here. We still have our hypothetical Ethereum situation where we basically come up and, you know, at least come up to the 200 exponential and simple, at least to the top of the range at 2100. You know, obviously, the Ethereum merge coming up here, potentially as high as like 2500. We'll see what happens. But, you know, so far, this is looking like the 5-wave structure continuation. We really don't know until we take out the top of the 3. When we take out the top of the 3, you know, obviously this was a 5th wave coming up here. In the meantime, as long as we're below the top of the 3, you know, there's still potential that this 5 waves is completed and that this is actually just like an A, a B, and then a C down of the initial 5 waves. So there's still a lot of scenarios in play right here for what could potentially be happening. Obviously, we talked about this Ethereum long position right here with the entry at the fib with the upside target of 30%. That would take us back up to the fib right above it, the green one at the 200 exponential and simple with a stop loss below the previous low. That gave us a 2.5 to 1 risk reward ratio. Not great. 30% upside, 11.5% downside. We're already like, you know, a decent chunk of the way into that move. And then the actual like macro target would be basically the completion of the 5 right here, 57% upside, 12% downside. So again, it's important to remember too, you know, I haven't been particularly bullish on crypto in general lately, and yet we still have bullish trade setups in play. Why is that? Well, because the key to success in these markets, in my opinion, is to make money when you're right and also make money when you're wrong. There's nothing wrong with having long positions on certain assets while you also have short positions on other assets. Sometimes you're going to be right about the long and the short at the same time. Sometimes you're going to be right about one and wrong about the other. Sometimes you're going to be wrong about both. You know, but if you build a strong enough case for why, hey, I want to be long Ethereum or I want to be long Bitcoin and I want to be short, you know, Nvidia or Apple, and you're like, well, wait, that doesn't make sense. You know, crypto usually moves with stocks. So why would you want to be short Apple, the best stock, and long Ethereum, the best crypto, subjectively? Well, you know, you got to build your own case. I'm not going to explain to you mine, but, you know, you guys know, obviously, that's my position currently. So, all right, so there's our daily. Pretty powerful move up here. We've got some clear targets on Ethereum. We have a pretty strong macro view. If you haven't watched the Ethereum macro, definitely highly recommend you check that out. We are reclaiming the 200 exponential for now. This looks substantially better than Bitcoin. Threatening the 21 on the weekly would be right around like 1835. We do obviously have momentum in our favor on the weekly as well. And as far as the monthly goes, you know, we did cross the 821 to the downside. We back tested it once. We're trying to bullishly engulf this next monthly and push back up here. Seems like the likely target would be 2100. Easily could see a bigger wick above that. Easily could see it fall short. but seems like 2100 is our next destination. Still very bearish on the monthly based on our indicator oscillators, but we know they're going to operate with a long lag because this is our monthly chart. So all right, and then let's look at our total market cap. So total market cap bouncing to 200. Simple once again. We know the target to the upside is about 1.07 trillion. Same thing. We're basically range bound at this point in time, between the moving averages. So we have the 200 simple as the lowest moving average. We have the 21 is the highest moving average. So I would expect us to basically bounce from 890 billion up to 1.16 trillion or something like that, and then chop around in this area. Now the direction we go after this is going to be huge. If we break back to the upside, it's going to look potentially very, very bullish. If we break to the downside from here, it's going to look very, very bearish, obviously. We don't know which one's going to happen. We're obviously in a downtrend, but the direction will be big. It's just a matter of, getting it right, which is 50-50 chance. So just flip a coin and, hope, wish, pray. Not my style, but. And then let's look at our Bitcoin dominance chart. So this is the full-on Bitcoin D chart, D dominance. So we had our, basically triple bottom right here, a low, a slightly lower low, a lower low after that. We had triple bullish divergence. We then broke out of the range. In hindsight now, when we look at this, it's much more just like a sideways channel. We basically have, well, I guess it's slightly sloped to the downside, but we came down here, we wicked down to a new low. And then since then, Bitcoin had a pretty aggressive move right here. So we know that aggressive move, there's only two ways we see Bitcoin dominance surge. And by surge, I mean go from a bunch of red candles in a row to a wick and a green candle, on the weekly, obviously. Because this is what the Bitcoin move amounted to. Bitcoin was able to capture back like 2%, maybe 1.5% of the total crypto market cap because it outperformed all of the shitcoins. So we know that there's two ways Bitcoin gains back market cap. It's either the shitcoins go down more than Bitcoin or Bitcoin goes up more than the shitcoins. So in this case, it was Bitcoin going up. So, if Bitcoin bottomed right here in relation to shitcoins, we know shitcoin's probably going to outperform Bitcoin. So if Bitcoin bottomed here, shitcoins are probably getting ready to surge. So Bitcoin dominance is probably going to melt down to new all-time lows, theoretically. If Bitcoin is just having a reaction rally and then shitcoins are going to not really have that same reaction rally, we could see Bitcoin dominance continue to move up here. The most important thing to watch is, basically what's happening with Bitcoin dominance and the momentum. Right now, clearly in a bear market, and the momentum is to the downside. Now, keep in mind also, this takes into account stable coins. So now let's look at our special chart. Thanks to one of the community members who, saved me from having to figure out how to do this on my own. This is our Bitcoin dominance chart as a percentage, less USDC and USDT. So basically, less the stable coins. So we get a more accurate picture of what's actually happening. Because part of that Bitcoin dominance chart relies on the fact that, you basically have people in speculative cryptos or speculative Bitcoin or not in either one of them. And then the total amount of money that's in speculative cryptos, either shitcoins or Bitcoin, that the percentage of Bitcoin in that is our Bitcoin market dominance. But now that we have all these stable coins, the stable coin is essentially the equivalent of being out of crypto, in my opinion. You may still be holding a, stable coin on a site, or you may be still, yield, getting some yield, lending, etc. But the fact of the matter is, you're not in the speculative portion. You're in a pegged currency, pegged 1-to-1 to the dollar. So that's not speculative. So it defeats the whole point. So this is just taking into account the speculative cryptos. We don't have all the biggest stable coins obviously in there. So this gives us a more accurate picture. Because if somebody says, okay, I'm going to pull out my money from Bitcoin and from shitcoins and put it into a stable coin, this chart will reflect that, as where the other chart will not. The other chart, just think about it as, a ledger. If we have on one side of the ledger speculative cryptos, Bitcoin, Ethereum, shitcoins, and then on the other side of the ledger, we have either, stable coins or just digital dollars on the exchange. In one of these charts, there's a difference. In the other one, there's not. Because if we move from dollars versus stable coins, we're still in the same ledger entry. It's just a matter of whether it says USDC or USD. As where in the other example, if we leave the crypto space, which is the total crypto market cap percentage of Bitcoin, we could leave the crypto speculative space, but still be in the crypto space. As where if we left the crypto speculative space, USDC or USDT, and went into dollars, we're leaving the crypto space altogether, even though we're still on the exchange essentially. So in this case, when we take out the money that's flowing into stablecoins, we actually see we're nowhere near as low on Bitcoin dominance. Nowhere near as low. So here we have, a low, a low, a low on the, including stablecoins, we're at that low again. Excluding stablecoins, we're substantially higher than that. So that tells me that there's actually more money flowing into stablecoins relative than there is flowing into shitcoins out of Bitcoin. Because here we see if we take stablecoins out of the mix, Bitcoin dominance is 47%. With stablecoins in the mix, Bitcoin dominance is 40%. So very, very important difference, in my opinion, as to what's actually happening. To be able to look behind the curtain as opposed to just seeing crypto as a blanket, total market cap, and Bitcoin's dominance therein. So very, very interesting. And that's what you would expect, honestly, in a bear market. So Matic on the daily, obviously Matic, one of the most bullish cryptos. Everything else is trash and completely melting down. Matic was actually able to tag its 200 daily exponential, just short of the 200 simple, consolidating in this range. Again, we basically have just a sideways channel. We had this, well, this doesn't really help us much, but we can see the entry from the long trade, and then we can see basically the top of the range. And that's basically just a sideways channel we're chopping around in. And eventually, the top of the channel is basically the 200 exponential and simple. Eventually, if we consolidate here long enough, we would expect a breakthrough of this. And that breakthrough would be the measure move from the bottom of the channel to the top of the channel. So it would likely take us up somewhere around like $1.50. So, there's definitely a potential bull case here on Matic. Obviously we have some crazy bull cases to like new all-time highs based on like fib extensions and stuff. We don't want to get too excited on that for now. But, if we start seeing more aggressive moves to the upside, it's worth paying attention to. So here we see the 382 is the bottom of the channel. The 0.5 is basically the top of the channel. And the 200 exponential and simple are now at the top of the channel. So very, very strong resistance at the 0.5 and the 200s. But if we can break through that, again, the measure move would likely take us to, the 618 or somewhere, even higher than that. So we'll be looking at like $1.25 would be my likely 50% target to the upside. So, is there a trade setup from where we're at right now? Let's say you didn't enter into a trade on Matic and now all of a sudden it's looking super juicy, or like, you missed this recent crypto pump and you're like, oh my God, I got to get into a position right now. Fuck, FOMO hit me hard. Twitter's going crazy. Everybody's talking about how they've just made 10% back of their like 80% that they're down. It's like insane right now. Everybody, like, people are buying Lambos left and right. I mean, my sister-in-law just retired from her investments in Shibcoin. I mean, stuff's getting crazy, guys. It's getting wild. Obviously, those are made-up scenarios, but I imagine they're probably what's actually happening. So, I mean, what's our target here? 41% upside and 14% downside. If we take out the lows, if we break down from the 382 on a daily close, we want out. If we take out the 0.5 and, the 200 exponential and simple, we would expect to move to 618. So 41% upside, 14% downside, 2.9 to 1, 3 to 1 risk reward ratio, minimum we want to take in a bear trend, which potentially we would be, arguably, if we broke above here and consolidated, this would be the flip. This would be the beginning of the bull trend. Maybe it just goes straight to zero, but there's definitely a possibility. So worth paying attention to this one, especially since Matic is one of the only good cryptos, based on the charts. I'm not like being mean. I'm just telling the truth. If you look at all the crypto charts, and you look at Matic, it's like, oh, this actually looks decent. Ethereum actually looks decent. BNB actually looks decent. Most cryptos look like trash. So BNB, had a nice aggressive move back up, tagged the 200 exponential and simple. We have this ascending channel in play. Did break down from the channel, broke out of it to the upside, came back down, found support, broke down from it here, back up, finding support. We talked about the two scenarios. One was, the massive short. One was the massive long. Right now, it's like Chop City in this bitch. Obviously, when we lost the channel, you don't want to be taking a long when you lose key support. If we close back inside the channel here, you may want to jump in on a long right here. 26% upside. I don't know. Obviously, that's up to you. There's a lot less meat on the bone now with that wick down, because you would have to put a 7% stop loss and say if we put in a new low, still 3.7 to 1 risk reward ratio though. There's still some potential here on Binance. All right, so hang on. There was a couple of cryptos that were requested as well. Jump in the chat real quick here. All right, so Heel says, what's up, brother? Good to see you. Angel says, hello. Can you please have a look at crypto, LUNC and LUNA? Dude, come on, man. Angel, I love you, man. I appreciate you being part of the community and everything. And, you know, you're always here, always participating. But you really want to look at Luna? You want to look at LUNC and LUNA? Dude, you realize that you're talking about speculating in a crypto that just blew up because it's a Ponzi scheme. It's a 100% factual Ponzi scheme. It literally blew up billions of dollars worth of wealth, and people literally lost everything. There's people out there that literally lost everything. They were trying to take a safe bet staking, or they were trying to speculate on the new big thing, and it went to zero. And that's what you want to look at? That's the cryptos you want to look at? Dude, no. No, I'm not doing it. I'm sorry. I refuse to look at Luna in any form, because essentially that's me participating in a pump and dump. And I have no interest in people losing their entire life savings. So you got to do it on your own, or I'm sure there is a million channels out there that have exponentially more subscribers than I do that will gladly look at only Luna, or specifically Luna, or whatever the other trash coin is. Like, I joke around about, you know, SHIB and stuff like that. You know, SHIB is just a trash coin. It's not like a full-on scam. Luna is a full-on scam. So no, I'm sorry. I will not look at Luna or LUNC. Sorry, dude. Just not going to be a part of that. Like, there's very few cryptos that I will refuse to look at, but I'm not looking at Ponzi schemes, dude. Especially after they've already broken up. And then that just shows you how unintelligent people are in the space, or how big of suckers they are, or just how desperate people are, that they're gonna, after something literally goes down by 99.99%, you realize Luna went down 99% like 5 different times. So everybody that put in, you're like, Luna's down 99%, I'll throw a couple $100 in it, and then a day later it's down 99% again. So you're a couple $100 is worth zero. And then people say, well, I'll give it a shot here. I mean, it's down 99% twice now. And then the same thing happened again and again and again. So literally orders of magnitude times it has gone down to zero, and people have gotten completely wiped out. No, there's no way. I'm sorry, man. I do appreciate you and everything, but just not happening. So Adam, yeah, Adam's another one. Adam is another one we've been bullish on recently. What else? Let me see the rest of the quests we got right here. Big D says Adam killing it too. Ralph Smith says Adam stayed mostly bullish even through the recent drop. Pretty crazy. Somebody knows something. I mean, it's just technicals, man. Like, you just look at the charts that look good. You know, Ethereum obviously stayed bullish through the recent drop. You know, Atom, BNB. I mean, is it because they're great projects? Is it because the chart looks good and, you know, that's why people are taking advantage of it? You know, that's up to you. You can call it technicals, you can call it fundamentals. I have found in my experience that fundamentals on very long time frames usually work, but on shorter time frames, they're almost always the opposite of what you should be doing. Technicals work on shorter and longer time frames, but you know, you can't take into account like fundamental of something based on a technical. Like, I can't price in, you know, what's going to happen with Ethereum based on a merge when we have a specific date and time there. I can't look at that on the technicals and tell you. I can look at fib extensions, I can look at like different tools or whatever, but I can't predict it in the same way that like a fundamental event tells you like, hey, this date and time, like leading up to it, some stuff might happen. So that's why it's important to use both, obviously. ALP says whales need liquidity to sell. 100%. I 100% look at all this as liquidity event. Big D, low people on Twitter use the Jim Cramer inverse indicator. Yeah, I mean, there's something to it for sure, but if you're trading, maybe you do well trading inverse Jim Cramer. But like honestly, I mean, look at Jim Cramer's calls for whatever it is, 20 or however many years he's been on TV. If you bought the stuff he's been saying and just held it for the last 20 years, you're probably like a big Jim Cramer fan. Because short term, sure, you might have been wrong about some stuff, but I mean, the guy's always bullish, and the stock market has always went up for like a decade, 2 decades, 100 years. So arguably, a long enough time frame, he's always right. Now, I'm not defending Jim Cramer. He's obviously a clown and for entertainment purposes only, but there's a guy who started with 15K and he is now around 150K. Pretty crazy. Yeah, I mean, I get what you're saying, Big D, but think about it like this, okay? If I start with 15K and I use 10x leverage and I'm right one time, I can be at 150K. Like, sure, we've been in a bear market now for, however many months confirmed, depending on when you determine it, 6 months ago or whatever. So sure, if for the last 6 months you just bet against Jim Cramer, you probably did good because he's always bullish. But if for the, 20 years before that you bet against them, well, you probably got wrecked, with the exception of a couple 6-month periods, in what, like 2008 and maybe like 2000. So, it's all subjective. I wouldn't stake my hard-earned money betting against Jim Cramer. Secret Network had a nice run as well. Yeah, I mean, you guys are getting into like cryptos I've never even heard of before, which doesn't say much, obviously. But yeah. I don't know anything about Secret in specific or particular, but if it's not in the top 100 cryptos, like, let's be real, I'm not touching it. For many, many reasons. I mean, if you look at the 4-year cycle and look at the amount of cryptos that even exist, like from one 4-year cycle to the next, you start thinking twice about speculating on like random trash cryptos, in my opinion. Because on a long enough time frame, most cryptos go away. So, okay, so let's look at Atom right here. So Atom has had a nice little run up. Obviously, we see a pretty clear ascending channel right here. I thought we had some. There we go. There we go. Hey, we did it, guys. So here is our ascending channel. We obviously broke down from it. It was looking a little sketchy. We had a upside target, 44% upside with a 8.73% stop loss. Came pretty close a couple times to the stop loss, and now we have completed the move. So up 44% on that one. And we do have a slightly higher target at up 74%. We had a pretty big wick here, another like 15%. But essentially that was a back test of a 200 exponential and simple. And we know that, our target to the upside was a back test of the macro 236. So basically we topped out right here. We came all the way back down to the 0.5, slightly overshot it. We came all the way back up to the 236, almost. Very, very close at this point in time. It seems like we'll get there. And then after that, what happens? Well, it's a 2 fib level bounce up. So we melt down to the 0.5. We bounce 1 fib level, 2 fib levels up. We likely top out, put in a lower high, and then roll over from there. If we consolidate above the 200 exponential and simple long enough, sure, maybe we flip the trend bullish. Maybe Atom goes into a bull run, whatever. Yep. So playing out very nicely on Atom, obviously. Another one that has been in our crosshairs for some time. And then Solana. So this one got a little nasty. We talked about some, potential situations here for like a super, super macro look here. Once we lost this, don't worry about these trade setups, as a matter of fact. These were basically I think we talked about these specifically in one video for the potential of Solana to actually do well. I can't remember what this was. The 1.618 fib extension? This might just be some kind of mess up. Yeah, okay. I don't know what the hell is going on here. I think TradingView malfunction. Like, I haven't been bullish on Solana for a long time, maybe ever. All right, so if we go back down here, from the low to the high, we came down to the 786. We're consolidating. We're still below the 786 for now. Doesn't look particularly good. I mean, it's acting as resistance clearly on the weekly. I would just be really, really careful with Solana. There's just so many reasons not to ever touch this. I mean, it's literally like the biggest crypto having the biggest problems. And by the biggest, I mean, like, not that it's the biggest one. Of all the cryptos having a bunch of problems consistently, Solana's at the top of the list. And it's also like the highest market cap of just, I mean, you could have some random crypto some dude made in like 30 minutes that's like crashing and having all kinds of problems, but nobody cares because the market cap's like $100. Solana, the market cap's extremely high. It's on like, you know, the top 100 list. I mean, well above the top 100 list. And it's constantly having issues. Hacks, you know, the chain is down, rolling back transactions, stealing whale wallets, like just nonstop like issues. So this is like, other than, you know, Luna and Angel's speculations, this is probably the worst place you could possibly put your money. I mean, I would put it in a slot machine before I would put it in Solana. This project is garbage and melting down. And we can see at the chart, it looks terrible. We broke down from the channel. Once you break down, obviously, the measure move should be from the top of the channel to the bottom of the channel. We underperformed that slightly. Didn't quite get there. Now we're trying to move back up here to the 786. I mean, in order for this thing to even start looking bullish at all, obviously you have a higher low. So that is a good sign. It's a good start. Man, it's using so much energy and going nowhere on the daily. This thing is rough. I mean, where does it go likely? I mean, the next key area to backtest would be, you know, basically like $45. So it's like a 33% move. You could arguably do a fib from the bottom to the top right here. We came down to the 786, back at the 0.5. So maybe you want to look at the 382 at like $38. And then after that, the 236 at like 41. And then a back test of the channel somewhere around like 45. But realistically, I mean, there's a lot better places, in my opinion, to speculate than Solana. Because it's just such trash. There's just so many reasons not to trade it. So many things that could go wrong. I mean, I would say probably, if you're looking for a trash bag crypto that's in, you know, like the top, whatever, 10, 20, 100 market cap wise or whatever, I think you could probably build a case for one of my favorite cryptos. You guys are going to love this one. I know that nobody here actually likes this crypto because I've spoken so much trash about it over time that anyone that even cares about this crypto at all has left the community or God's green earth itself. But that being said, you know, there is some potential here for something to happen. On Cardano. What the fuck? I know this is some sort of joke. Am I being punked right now? Cardano? Are you serious? That's the crypto? Well, I mean, there's potentially some, you know, bullish catalysts. It's a strong community. Lots of people have their coins locked up. It's been holding the 382 for some time. I mean, it's obviously pathetic garbage crypto. I do not like it at all. I do not like Charles Hoskinson at all. But, you know, there is an argument to be made. I don't know. This looks like trash, guys. Let's be real. It's hard for me to try to make an argument for something that just looks like trash. This chart looks terrible. It's literally dead at the 382 doing nothing. It seems more likely than not it's going to break down to the 0.5. But, you know, I get it. There's, you know, potentially some bullish catalysts coming up right here. This is a hedge against Ethereum in case something goes wrong, whatever. I could see Cardano potentially breaking out of the descending resistance and back testing like 65 cents to like 92 cents, maybe. I don't know. This chart looks so terrible to me. It's really hard for me to even try to make a case for this. I know people like want me to, but there's just, this is a tough situation. You know, because as soon as we break through this resistance, you know, let's say, you know, the bulls take over and Cardano moves up here and retests 53 and then breaks out. Then it immediately has another strong resistance at 58, which is also the previous peak, and a bunch of chop right here. And then after that, the 200 exponential and simple. So, you know, you're basically looking at like an initial push up of like 7%, followed by potential push up of 17 total percent, followed by a potential push up of like 35%, followed by a potential push up all the way to the 236 back test of 85%. Now, do I think that that happens? No, I don't. I do not think that happens. But it's worth paying attention to. There's definitely a possibility for it. So, but I know a lot of people wanted to hear about Cardano and everything going on here recently, and I just don't see it, guys. I know people are getting really bullish here, and people are calling for 80 cent and $1 Cardano again or whatever, and we're at 50 cents, so it's like, oh, that's a double. That's great. But like, those are the same people, keep in mind, that are like hodling from $3. So they're down substantially. Substantially. I don't know. I wouldn't get bullish on this yet. I know people are trying to use it as the Ethereum hedge, but CN says ETH Bitcoin still in an uptrend. Yeah, sure, man. Sure, of course it is. There's a massive catalyst for ETH going on right now, and you know, until that happens, buy the rumor, sell the news, right? That we talked about that 100 times. Why is ETH so strong right now? Well, because there's 20,000 cryptos and 19,950 of them are trash, and 50 of them have a decent chart. And of the ones with a decent chart, ETH is the biggest. And of the ones with a decent chart that are the biggest, ETH has a bullish catalyst, you know, fundamentally coming up. So sure, of course, ETH compared to Bitcoin is bullish. Agreed. Big D says crypto trend trader is trolling us with Cardano. Yeah, it's such trash, man. I was trying to build like a positive case for it because people have been asking about it lately, but I just don't see it. It's such garbage, guys. Come on, let's be real. It's going to zero. Big D says the big green candles on Solana. The big green candles on Solana. I don't know what you're talking about, dude. You're saying there's about to be a big green candle on Solana? I mean, if you were going to bet on what Solana's about to do next, I would bet that it goes to $10 before it goes to $70. So this is 70 up here. So I think it goes, I think you lose, I think it goes to $10. So you lose over 66% of your money, close to 75% of your money from where it's at right now before it goes up to 70. So a double. That's my opinion. You know, now could I be wrong? Sure. Maybe it goes to 70 tomorrow, but I mean, I wouldn't count on it. Let's be real. If Solana goes to 70, there's some other way better cryptos that have over doubled in price. I promise you on that one. I don't think Solana all of a sudden is just going to be like amazing. You know, once you're like the ugly dog and everybody hates you, it's hard to get back. And with Solana, the problem with this is, I mean, this is the Coinbase chart. So obviously there's lots of other charts we can look at as well with more price history. But, you know, Coinbase, the biggest US exchange, you know, it's kind of a big deal. So this big red box right here is all the retards that bought Solana that are upside down on their position. Now, some of those retards have lost 86% of their money. Those are the most retarded retards. Some of those retards are break even because they bought exactly where we're at right now. And, you know, it's only just cost them, you know, the massive run up from August 2021. And then they never took profits, probably bought more along the way. And then we're all the way back at where they started again. So they're not as retarded, but still pretty retarded. And then those are all the losers in red. That's all the losers on Coinbase. Now, again, there's lots of people that bought it at better prices, lower prices before it was on Coinbase. It's definitely a thing. But just for a reference, you know, because it's the biggest US exchange. And most people probably got access to Solana once it was listed on Coinbase and not sooner. So if we look at all the people that are upside down and all the losers in Solana, and then we look at all the winners in Solana, and then we look at how much the winners have won and how much the losers have lost. Like if you bought the bottom of the wick, the absolute lowest low ever on Solana, and rode it up to where we're at right now, you're up 71%. That's pretty good. But you were up 1,182%. And then if you bought the absolute, worst time ever for Solana, that's our example before, you went down 86%. So if you bought the absolute bottom, you're up less than if you bought the absolute top. And the majority of the people bought in all this price action, and then there's a itty bitty little bit of people that bought down here. So every time Solana tries to move to the upside, every time this piece of trash, garbage, crypto does anything positive, there's this many people, there's this much price action above its head getting ready to just beat the shit out of it, kick it in the mouth, and push it back down to zero. And then every time it moves to the upside, there's this itty little bit of people right here. Just the bulls. We're Solana bulls. We're bulls. Solana's great. And it's the best thing in the whole world. And then here comes the Grim Reaper of all these people right here to just chop off its head, kick it in the dick, and throw it down some stairs. So, is it difficult for someone like me to get bullish on Solana? It is. It is. Even if this was just the chart and none of the fundamentals were there, and like Solana wasn't always crashing, they weren't like confiscating people's crypto, they weren't having like constant hacks and people's crypto wallets getting compromised, and just all these just horrible things that are plaguing Solana right now, making it just complete trash. If all that wasn't true and we were just looking at the chart alone is fucking disgusting and very, very disgustingly scary, and just the last place I would ever put my money. If somebody literally brought this to me and said, hey, is now a good time to invest in Solana, I would backhand them across the face and then, throw them out of my house. Wow, that's a little harsh. I would probably just laugh at their face and be like, probably call them a retard or something. That's actually what I would probably do. So yeah, I mean, for me, Solana, garbage, complete garbage. The worst thing ever. Total trash. I would literally rather buy something like Dogecoin than Solana. Yeah. God, that's a bold statement. Is that actually true? Would I rather buy Cardano than Solana? Yeah, I think I would. Yeah, I mean, Solana's basically at the list, the very, very bottom of the list of like cryptos I would ever be interested in. And keep in mind that I rode Solana all the way to the top and basically was sold very, very near to the top. So I don't mind making money in the thing, but let's not fall in love with it. Solana's trash. Thought you were going to say XRP. Yeah, I know there's a couple of them that could have got the dig there. The XRP chart probably would have looked better, honestly, than the Cardano one. To tell you the truth, like, people have just been asking about Cardano lately, and like they have a new, situation coming up, Voldemort or whatever. That's a joke, by the way. They always have some like funny name for some retarded thing that nothing ever is better on. I mean, they got their test network, and they got Charles out there shilling for him. But to tell you the truth, like, there was a bunch of talk lately about how strong Cardano is, and like how it's like the ETH killer, and like, that it's the hedge for Ethereum with the merge coming up in case something goes wrong. And I really thought the chart was going to look better than that. It was kind of shocking when I pulled it up, just how terrible it is. Eli says, Binance chart has some more history on SOL. Yeah, I mean, it doesn't really matter, though. I don't really care. I mean, the reason, like I said, you can look at the longest history on anything, but, if you look at the volume, look at the market cap of what Solana was prior to getting listed on Coinbase versus after it got listed on Coinbase, gives you a much more accurate picture as to like where the majority of price action took place. And then also, if that's the biggest change in the United States, most volume taking place on it, and the majority of, a very large portion of crypto activity is taking place in the United States, it makes sense to look at the exchange where everybody would have got access to it. Like, for sure, we can go look at like KuCoin or something on like some old crypto, like KuCoin the exchange, on like some old crypto that had like a tiny little market cap, and the history might go back like super long or whatever. But it doesn't really matter because nobody was buying it back then. When something gets listed on Coinbase, all of a sudden it has exponentially more people have access to it. Like, the amount of people that are using like Uniswap or something and getting early access on like shitcoins compared to the amount of early access shitcoins they're putting money into, it's like a fraction compared to like the amount of people that buy a crypto the second it gets like listed on like Coinbase, especially in a bull market. So that's why I'm not as concerned with like the price history. But obviously appreciate you throwing that out there. But yeah, I mean, it really doesn't make much sense or like difference. In retrospect, once it got listed on Coinbase, the easy part of the trade was over. Once it got listed on Coinbase. Yeah, I mean, the actual Coinbase had a crazy good run up. It's not like it didn't have, a massive run up along the way. I mean, this was a massive run up from when it got listed on Coinbase. So I wouldn't say the easy part of the trade was over. It got listed at 40 bucks, dropped down to 20, but I mean, it went up over, I sold at 200 and it went up over like, I think it was like 240 or something like that. So I wouldn't say the easy part was done. I just mean like, most of the people that bought into that are probably losers. So we'll look at gold and all that stuff real quick, and then we're going to go ahead and wrap it up. We're already over like 2 hours. So gold just hanging out at the lows. I don't see anything bullish here. Obviously still tied to assets the same way. Silver, again, same thing, back testing resistance. Slightly more bullish as of late. We're seeing a little pressure on the gold to silver chart. Commodities had a nice little push back up off the lows, back above the 200 exponential and simple, holding on for now at the bottom of the range. Likely do see another push up here. What happens if we put in a higher high or a lower high? It's going to make a big difference. FCG, so we see nat gas kind of rolling back over here, looking a little more bullish. Contrary to what we're seeing with oil putting in new lows and a little strength, we see like the nat gas plays are holding up strongly. We talked about essentially how something like XLE is probably a better idea right now, while the energy trade is kind of diverging. We're seeing oil kind of weaken while nat gas continues to strengthen, or at least stays strong. So, it makes sense to have some diversity within the space. We see CCJ putting in some new highs right here after that recent little touch of the 786 and then the 886 as well. Uranium still holding on strong right here, threatening the highs. Obviously, CCJ looking stronger than most other ones. I'm still not ready to flip the script on this. If we get up here and consolidate at or above the highs, that will change. The problem is CCJ looks pretty damn bullish, but something like URA, I mean, clearly just in a range, not looking good right now. Descending channel, looking pretty toppy right here, attempting to reclaim key levels. UUU, very, very similar. And then we see UROY, much weaker, again, trying to reclaim those key levels. But the fact of the matter is, we're seeing one, this is obviously worse. UROY is obviously worse than pretty much anything. CCJ is obviously better than pretty much anything. So right now I'm a little more focused on the meat of the sector to see what's actually happening for like overall direction. Because in my opinion right now, we're very close to, basically, if we break out to upside, we're going to new highs. If we break down from here, or at least retest the lows, we're going to new lows. I want a better opportunity to buy back into a lot of these uranium stocks. But I'm not going to miss a massive bull rally. So ideally, I would like to buy these 25+% cheaper than where they're at right now. And we have some clear targets in place, on these various uranium stocks. Like for instance, URA, where it's at right this second, I would like to get it down here, 20, well, let's say 30 to, 40% cheaper. And that's going to make a massive upside difference once we bottom and go to new all-time highs. And you guys know, I'm very, very bullish on the uranium space in general. But I think what's happened is we played out five-wave structure and we're just consolidating in the downtrend before we bottom. Now, is it possible we already bottomed at the 382? It is definitely possible. So if we break out from here, from this descending resistance, I'm probably going to go ahead and flip on uranium, at which point in time the 200 exponential and simple will flip back blue, and then I'm going to long it again until they flip back bearish again. So I will essentially just re-enter at these levels with less risk and more upside potential. Now, if we roll over here and come back down, we'll probably get our entry. Now, we've had a couple times along the way where we could have bought at a pretty nice price. I looked at those as scalps because it looked like more of resolution inside of the range. If we come down here and put in the low target I'm expecting or hoping or, looking for, that would be basically a breakdown from the range, but likely will end up being the macro bottom. As where if we break out from right here, that's likely the finish of the consolidation, at which point in time we threaten this peak, we threaten that peak, and then we're at new all-time highs. And well before that happens, we'll have essentially, flipped the 200 exponential and simple back bullish. And the majority of the uranium space will be saying the same thing, not just CCJ. It will be URA and UUUUUUUU and like some of these other plays as well. So that's what I'm looking for. I'm looking for the majority of the uranium space to be essentially saying, hey, we're probably done going down for now. We're ready to go back up. when I look at the longer time frames, that's not the picture I'm necessarily getting. Now, it's starting to look better. We're starting to see the weekly 821 cross back to the upside, the hard buy, all green histograms. But this really just looks a lot like pretty much every like equity chart right now that we look at. You know, we saw that same kind of fake out take place on the Dow and the S&P and all these things on the weekly. So is this just sort of getting that same weekly bounce before we come back down? I think probably it is. I think it probably is. But, you know, we'll have to see in time. Obviously, this is pretty clear cut what we're expecting. We already had the ABC initial play out and then had a nice bounce off of that. Had some nice scalps within this range. You know, still below the areas we took profit on, which is good. But obviously, if we, you know, we're expecting new highs, you know, we would have been much better off buying down here, clearly in hindsight. But if we're expecting this to roll back over, we'll have another opportunity to actually buy at lower lows, which is what I'm going for, which is a back test of the 200 simple. Again, this is a very, very bullish chart. Long term, medium term, short term, it could go either way. And honestly, medium term right now, if this rolls over right here at our target and starts to sell back off, the medium term is going to look obviously pretty bearish also. Now still macro bullish, but it's going to look much more likely that we're headed down here like 16 bucks. So that's what I'm seeing on uranium. It's definitely starting to paint a picture for like, hey, we could actually see some continuation. And, you know, maybe we should be getting back into this. Just not quite there yet, in my opinion. So pot stocks, CGC, again, nice little move up here. You know, I mean, these things are so beat down at this point in time. Any kind of move back to the upside is like a nice percentage move. I mean, in these last three candles, 16% move, pretty big deal. Crossing the 821 back to the upside or avoiding the cross. I did not re-enter any of these or anything. I'm kind of waiting to see how they play out. Tilray, again, at the lows, still expecting new lows, much more bearish. ACB, trying to confirm the cross back to the upside. Again, hang out at the lows. Sundial, decent amount off the lows, but, you know, somewhere in between. And then something like Kexo just looking like straight trash right now. So we see obviously CGC holding up substantially better than the other pot stocks right now. We are seeing a decent amount of volume here at the bottom. So, you know, is there a possibility that this is actually like macro bottomed and it's all done and it doesn't go lower? It's possible. I think more likely we broke down to key support and back tested all this support right here. And now we're kind of back testing that resistance. We'll see what happens. Obviously, a lot has to happen for us to get like super bullish on this. I did take profits on this. We are basically like approaching the area I sold at. So it could arguably go higher and complete this trade, which I would have missed out on the last bit of it. But I'm okay with that. I'm okay with that. I'm not particularly bullish on the pot stock sector right this second with this recent price action. Doesn't change my overall look. I think these things are trading at like extreme values. I mean, this was the back test of the 786. So it's possible that was the low. And we actually have like our macro low here. And then this was our 786 low. And we don't go any lower. And then this would give us a 618 retrace. And then we come back, we put in a higher low for once. And then maybe we move out to the 0.5. And then we can start talking about, you know, hundreds of % gains at a time. Still just a little early to jump the gun on that because all this has been doing is just literally melting down for years. So, yeah, so I think that's going to do it for today. I think we pretty much touched on anything. So starting to have a little bit of a bullish case build for, you know, crypto, obviously on the shorter time frames, still well off like a daily bull case or anything like that. We know that any rally in equities, whether it is stocks or cryptos, is 100% reliant. It must rely on weakness in the DXY and weakness in the 2-year or whatever treasury, you know, yield or whatever you're looking at. So the most important thing, in my opinion, is same thing still. Just watch inflation, you know, because we know what that means. Watch the rates, watch the DXY. You know, we basically back tested clear resistance as support. It's holding for now. There's a couple bearish candles in the row on the DXY. There's definitely some bearish divergence. There's potential for lower prices. Definitely. But I would not get overly excited on it because it's happened over and over again and people have, you know, been up shit's creek. Now, let's say the bull case scenario happens for equities. Let's say the dollar breaks down from here and starts showing weakness and starts threatening the 105 level. Let's say that whatever happens with yields for some reason TNX starts to roll over and we start retesting these lower levels, what's that going to mean on our cryptos and stocks? Well, it's likely going to mean, the stocks backtest their 200 exponential and simple again, which is a nice, maybe, it's not that much of a percent here. It's another 3 to like 4% basically on the Dow, and, similar on S&P and whatnot. What is it going to amount to on cryptos and Bitcoin? At some point in time, if enough bullish things happen, eventually, maybe we make it to 28K. Do I think we're about to have 7K pump in Bitcoin and crypto? No, I don't. I don't think it's going to happen. Is it possible? Sure. A lot of things have to happen along the way, but that's like 33%. So we'll keep an eye out for it. Nothing really changing right here. I know we get a 10% day. Everybody gets excited. We see a pump after melting down. But, let's be real here. Nothing has really changed. We're basically just inside the same range again, just going sideways, doing nothing. When we get to the bottom of the range, we would expect to push back up. When we get to the top of the range, we would expect to push back down. That's all I'm seeing. We'll see what happens over the weekend. If we see sort of a strong close on equity markets, kind of a weak close on the dollar and yields, maybe we finally get one of these weekend pumps. We've had plenty of opportunities though, and none of them have stuck or even happened. So I wouldn't get too excited on it for now. I'm looking at like that like almost whatever it is, the 4 hour 200 simple, 21,625. That's what I'm looking at. So another like $300 to the upside. After that, we'll see what happens. Probably some consolidation over the weekend, some pushes higher, some pushes lower. And then next week we can kind of see what happens. But again, the timer's kind of ticking down again. So, until we get that next Fed fund hike, hard for me to get bullish. Nothing has changed on the macro. Now, if that changes, I'll change, obviously. But got to stick to the plan. So yeah, go ahead and wrap it up there. Hopefully everybody enjoyed the stream today. Obviously none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. It is Friday, 1:26 p.m. Eastern Standard Time on 9/9/2022. I am Crypto Trend Trader, and this is our Friday morning, afternoon market wrap up now. Obviously, you can check us out for our live streams every single Sunday and Wednesday from 8 p.m. till roughly 10 p.m. And, of course, every Friday from 11 a.m. till usually about 1 or 2 p.m. Eastern Standard Time. But that's it for today. Remember, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Crypto Trend